इन्वेस्टमेंट का ऑब्जेक्टिव जो भी हो, मोतीलाल ओसवाल इंडेक्स फंड है ना भाई।
Index funds from Motilal Oswal, India's widest range of index funds for every kind of investor. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
मेरा डिसाइडेड है, मुझे इक्विटी करना है ट्राई।
रिस्क चलेगा मुझे, बट आई एम फॉर रिटर्न्स टू फ्लाई।
हमें क्या पता विच फंड्स टू बाय।
मेरा तो आई एम ए रूल बेस्ड गाय। ऐसा कुछ जहां सोना और चांदी दोनों में इन्वेस्ट हो जाए।
माय फंडा जस्ट डाइवर्सिफाई। एक इन्वेस्टमेंट में पूरा एसेट एलोकेशन सॉर्ट हो जाए।
इन्वेस्टमेंट का ऑब्जेक्टिव जो भी हो, मोतीलाल ओसवाल इंडेक्स फंड है ना भाई।
Index funds from Motilal Oswal, India's widest range of index funds for every kind of investor. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
मेरा डिसाइडेड है, मुझे इक्विटी करना है ट्राई।
रिस्क चलेगा मुझे, बट आई एम फॉर रिटर्न्स टू फ्लाई।
हमें क्या पता विच फंड्स टू बाय।
मेरा तो आई एम ए रूल बेस्ड गाय। ऐसा कुछ जहां सोना और चांदी दोनों में इन्वेस्ट हो जाए।
माय फंडा जस्ट डाइवर्सिफाई। एक इन्वेस्टमेंट में पूरा एसेट एलोकेशन सॉर्ट हो जाए।
इन्वेस्टमेंट का ऑब्जेक्टिव जो भी हो, मोतीलाल ओसवाल इंडेक्स फंड है ना भाई।
Index funds from Motilal Oswal, India's widest range of index funds for every kind of investor. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
मेरा डिसाइडेड है, मुझे इक्विटी करना है ट्राई।
रिस्क चलेगा मुझे, बट आई एम फॉर रिटर्न्स टू फ्लाई।
हमें क्या पता विच फंड्स टू बाय।
मेरा तो आई एम ए रूल बेस्ड गाय। ऐसा कुछ जहां सोना और चांदी दोनों में इन्वेस्ट हो जाए।
माय फंडा जस्ट डाइवर्सिफाई। एक इन्वेस्टमेंट में पूरा एसेट एलोकेशन सॉर्ट हो जाए।
इन्वेस्टमेंट का ऑब्जेक्टिव जो भी हो, मोतीलाल ओसवाल इंडेक्स फंड है ना भाई।
Index funds from Motilal Oswal, India's widest range of index funds for every kind of investor. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
मेरा डिसाइडेड है, मुझे इक्विटी करना है ट्राई।
रिस्क चलेगा मुझे, बट आई एम फॉर रिटर्न्स टू फ्लाई।
हमें क्या पता विच फंड्स टू बाय।
मेरा तो आई एम ए रूल बेस्ड गाय। ऐसा कुछ जहां सोना और चांदी दोनों में इन्वेस्ट हो जाए।
माय फंडा जस्ट डाइवर्सिफाई। एक इन्वेस्टमेंट में पूरा एसेट एलोकेशन सॉर्ट हो जाए।
इन्वेस्टमेंट का ऑब्जेक्टिव जो भी हो, मोतीलाल ओसवाल इंडेक्स फंड, है ना भाई?
Index funds from Motilal Oswal, India's widest range of index funds for every kind of investor. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
मेरा डिसाइडेड है, मुझे इक्विटी करना है ट्राई।
रिस्क चलेगा मुझे, बट आई एम फॉर रिटर्न्स टू फ्लाई।
हमें क्या पता which funds to buy?
मेरा तो आई एम ए रूल बेस्ड गाय। ऐसा कुछ जहां सोना और चांदी दोनों में इन्वेस्ट हो जाए।
My funda, just diversify. एक इन्वेस्टमेंट में पूरा एसेट एलोकेशन सॉर्ट हो जाए।
इन्वेस्टमेंट का ऑब्जेक्टिव जो भी हो, मोतीलाल ओसवाल इंडेक्स फंड, है ना भाई?
Index funds from Motilal Oswal, India's widest range of index funds for every kind of investor. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
मेरा डिसाइडेड है, मुझे इक्विटी करना है ट्राई।
रिस्क चलेगा मुझे, बट आई एम फॉर रिटर्न्स टू फ्लाई।
हमें क्या पता which funds to buy?
मेरा तो आई एम ए रूल बेस्ड गाय। ऐसा कुछ जहां सोना और चांदी दोनों में इन्वेस्ट हो जाए।
My funda, just diversify. एक इन्वेस्टमेंट में पूरा एसेट एलोकेशन सॉर्ट हो जाए।
इन्वेस्टमेंट का ऑब्जेक्टिव जो भी हो, मोतीलाल ओसवाल इंडेक्स फंड, है ना भाई?
Index funds from Motilal Oswal, India's widest range of index funds for every kind of investor. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
मेरा डिसाइडेड है, मुझे इक्विटी करना है ट्राई।
रिस्क चलेगा मुझे, बट आई एम फॉर रिटर्न्स टू फ्लाई।
हमें क्या पता which funds to buy?
मेरा तो आई एम ए रूल बेस्ड गाय। ऐसा कुछ जहां सोना और चांदी दोनों में इन्वेस्ट हो जाए।
My funda, just diversify. एक इन्वेस्टमेंट में पूरा एसेट एलोकेशन सॉर्ट हो जाए।
इन्वेस्टमेंट का ऑब्जेक्टिव जो भी हो, मोतीलाल ओसवाल इंडेक्स फंड, है ना भाई?
Index funds from Motilal Oswal, India's widest range of index funds for every kind of investor. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
मेरा डिसाइडेड है, मुझे इक्विटी करना है ट्राई।
रिस्क चलेगा मुझे, बट आई एम फॉर रिटर्न्स टू फ्लाई।
हमें क्या पता which funds to buy?
मेरा तो आई एम ए रूल बेस्ड गाय। ऐसा कुछ जहां सोना और चांदी दोनों में इन्वेस्ट हो जाए।
My funda, just diversify. एक इन्वेस्टमेंट में पूरा एसेट एलोकेशन सॉर्ट हो जाए।
इन्वेस्टमेंट का ऑब्जेक्टिव जो भी हो, मोतीलाल ओसवाल इंडेक्स फंड, है ना भाई?
Index funds from Motilal Oswal, India's widest range of index funds for every kind of investor.
Read ka profile. Yeah. Ask transfer you send me. Yeah, take it back. Ready? Realize. Okay. Oh, great. Good evening, friends. Great. Yeah, good evening, friends. Thank you for being here and looking forward to having a great conference conclave with all of you. This is our third edition, and we hope to do a lot more in the future. Today we have a very exciting lineup, and I'm extremely excited to announce and talk to all of our speakers. We have speakers from different geographies, and also have some very interesting panel discussions with the industry. So I'm very excited for today's show. But before that, I just wanted to maybe spend about maybe 3 or 4 minutes talking about what we're doing out here. So Motilal Oswal Asset Management Company has been have been one of the pioneers in the space of passive funds in general. We were the first ones to launch a lot of funds over the last decade or so, and we have had good amount of leaderships in the index fund space, international funds, and also factor funds. We'll obviously go into details about products, but today the idea behind this conference is to more about investor education, about how passive funds have really increased in popularity over the last 4 to 5 years time. I would say if you look at the industry overall, passive funds were maybe less than 6 or 7 thousand crores in assets. I would say about in 2015, which is about 7 to 8 years ago. And that today has risen to almost 8 lakh crore plus. We've also seen that the market share of passive funds today in the entire mutual fund industry has grown to about 17%. From I would say less than maybe 1 or 2%. 5 years ago, and we've also seen that incrementally today for the last 5 years, 1/3 of all flows into equity funds happen in passive funds. So it's been a very we've seen when you ask most investors, they look at passive funds as Nifty and Sensex. But today we have hundreds of ETFs and index funds that have launched by multiple AMCs. Some of them we'll talk to them today, and we are seeing good amount of innovation happening in the space as well. More than products, we've also seen a lot of adoption happening from customers. We at Motilal Oswal did a very interesting investor survey last year, where we decided to ask a lot of our users, as well as it was open to the public, about what has been the adoption of passive funds in the industry. And yes, there has been a lot of adoption happening from institutions, but increasingly over the last 2 to 3 years' time, we're seeing a lot of retail investors also adopting passive in a very meaningful way. In our sort of survey, we found that over 60% of all respondents have invested in at least one passive fund, and I think about almost 85 to 90% of them have chosen index funds over ETFs for their simplicity. And about 3 out of 4 of the respondents have preferred SIPs, which means that they're looking at passive funds from a very long-term perspective. So those are some of the insights about how the industry has grown, how investors have adopted passive funds, and we as an AMC also have grown leaps and bounds in this space. We were managing close to very small capital about 5 years ago, less than 100 crores. Today we crossed 20,000 crores plus. So we've also seen a lot of sort of growth for our industry, and also we now have one of the largest number of funds in the space. Maybe between 30 and 35 funds within just passive funds, and we hope to launch a lot more in the future. So that was just an introduction, and welcome. We have a lot of sessions. We start off with an excellent writer. Her name is Monica Halan. I'm very excited to talk to her, to Monica today. It's the first time I'm interacting with her, so looking forward to it. And before I introduce her, I just wanted to maybe talk about her in terms of a brief background. So Monica Halan is a trusted personal finance writer. She's known for a book, Let's Talk Money, which is a bestseller. I think it's one of the best books written in personal finance, according to me. And I do, hope a lot of people out here go out there and buy that book. It's excellent. So she has a 30-year career that spans across media, public policy, and financial education. She's also the founder of Dhan Chakra Financial Education and author of best-selling books. I talked about, Let's Talk Money, which has been translated into multiple languages. So please do pick up a copy. She's also the chairperson of SEBI's Advisory Committee for Investor Protection and an education fund, and also a member of the Hybrid Securities Advisory Committee. So that's about her. She has worked across different media organizations in India, and this includes Mint, Economic Times, Indian Express, and was also an editor of Outlook Money for some time. She also runs a successful TV series around personal finance in NDTV. So please, and she has done MA in economics from Delhi Public School, and also an MA in journalism studies from University of Wales. She's also a Yale World Fellow, and she's based out of Delhi. So with that, I would like to invite Monica to please come in and maybe say some few words, and then we can obviously have a short Q&A after that. So over to you, Monica. Thanks for coming.
Thank you so much, Prateek. Thank you for the invite, and I'm delighted to be here on this conclave. And like I tweeted, passive fund investing is one of the things which is very close to my heart, especially for newbie investors into the stock market. So if the time allows, maybe I'll take about 10 minutes and just do a short talk on the way that I see retail investors need to approach this space. Is that how your program is structured, Prateek? I can take about 10 minutes.
Yes, that's fine. I think 10 to 15 minutes is fine.
Oh, 10 to 15 is fine. Okay, great. So what I have found through what you said, long years of work in the space of money and personal finance, is that especially the new investors think about mutual funds as a get-rich-quick scheme that you invest in 3 years. And the bull markets of the last few years have given, especially the young adults who've just entered the market, fairly unrealistic expectations about what the stock market can do. But I think what we need really to put down very concretely is that it takes a long time, and we need to look at very long-term growth rates. Also, investing through mutual funds and specifically equity funds, we need to be able to do the maths and decide which route towards investing we are taking. So if you take the growth rates of
Hi,
different
Monica.
yeah.
Is it possible for you to slightly speak up?
Okay. Is it, am I better audible now?
Yes, fine. Thank
Okay,
you.
great. So, if you look at the different return rates of products, take fixed deposits, take PPF, take gold, and then take the Sensex. Sensex, for those who don't know, is the 30 stock index on the Bombay Stock Exchange. And we have long-term historical data for this. So if you look at the different return rates, you see that while fixed deposits, gold and PPF will give you returns between 8.5 to 9.5% average annual. It will turn 1 lakh into, say, 18 to 19 lakh. The same amount of money riding on the Sensex, which would turn it to, say, 64 lakh. Okay, so that's the difference that you have over the long term in investing through the stock market. Now, when people approach the stock markets, they think of, how do you get these returns? What is the best way to target high returns in the market? Because the problem really is of volatility. People are afraid of the volatile nature. And I want to give an example of India's unluckiest investor. So let's say there is one person, she always invests when the markets are at the 52-week high. Everyone knows that there'll be one day in the market when the Sensex or the Nifty will close at the highest point of the year. So let's say this person invests 1 lakh rupees for 30 years at the 52-week high. Year after year after year, she does that, and she invests and the market falls. So over 30 years, she's put in 30 lakh rupees. What do we expect her corpus to be after 30 years? Because she's the unluckiest investor, she should have done badly. But when you do the maths, and I have personally done the maths on this one, you realize that her corpus after 30 years is 2.3 crore. And this is the story of India's unluckiest investor. All that she has done is that she has systematically invested in something called the Sensex. Okay, now the thing is that what I would like to communicate to investors. So some of the people listening in are new investors, some have been exposed to the product called mutual funds and passive investing. There are two things that we are afraid of. One is this volatility, that stocks go up and down and your returns can really crash. And the COVID period really told us the fact that you can have a market event which sees the wipeout of 20 to 30% of your net worth. It was a difficult time for all of us. Even market veterans who've been in the market for so long, that event really shakes your faith in markets. But for those who held on, we quickly realized the power of a market when it bounces back. So volatility, having the stomach to deal with volatility is a very key part of investing in the markets. And the second part is expectations, the sort of unrealistic expectations that people might have. So I will talk about this volatility piece once. One way to deal with volatility is very long-term investing. But before that, the way that I like to present investing in the stock markets through a mutual fund and in mutual funds through something called passive or index-based investing is that we want to do long-term investing with seat belts on. So we want to participate in the growth that markets give, but we want to do that with seat belts, or we want to protect our today while investing for tomorrow. So what is it that makes people afraid of committing money to markets is the fact that you can have an event and you can see the wipeout of a part of your net worth. For that, what I recommend is that you put in something like, you seat belt yourself to the present. And for that, what you do is you create an emergency fund, 6 months of living costs in either a fixed deposit or a very low risk debt fund, which gets your money to you very accessible. There's very little risk, no risk of capital uh, depreciation, your capital is not at risk. So whether it's a fixed deposit or a very low risk debt fund, you collect your emergency funds in that. That's your first seat belt. You're getting prepared to invest, to get your money to invest for the long term. The second would be buying medical insurance and life insurance. Medical insurance, because when there's a medical emergency, you don't want to dip into your funds, and especially at a time when markets may be going through a bear phase. You don't want to be redeeming your equity product at the point when markets are really crashing. It hurts you to take home those losses. So the presence of a medical insurance prevents you from dipping into your savings, which you have built over a period of time. And the presence of a life cover, only a pure term life cover, please don't fall into the traps of endowments, money bags. Those products do not work for individuals. They work for banks and agents and insurance companies. They don't work for you and me. So life insurance for the principal breadwinner through a pure term insurance plan. So you're beginning to get your seat belts in place so that you can commit money to long-term investing. And long-term in my world is at least 7 years. You must have at least 7 to 10 years to commit your money to equity. Only then do you enjoy the fruit of this asset class. And the third thing you need to do is you've got to break up your investments into short, medium, and long-term buckets. Because you see, the way we think of products is the way that they are sold to us. But the way we need to think about products is the way we need the product. So I will have needs for money within the next 3 years. I might have needs which could be anything. At different ages and stages, you will need money for different things. So a starting out family might need money for a down payment of a house, for buying a car. A more mature family might need it for the children's higher education. And so you may be wanting to pay off a home loan at a later date. So the system allows you to put your own goals in place. What are the short, medium, and long-term goals? And the products for these three buckets will differ. I remember once, this is a long time back, I've been part of many government committees, and there was one joint secretary, and he was saying debt funds don't work. They just don't give the return. So I said, what do you have? Genius had put his money in a very long term. The average maturity of that bond fund was 10 years, and he was looking at short-term return. You cannot use an aircraft to reach the neighborhood market. You cannot take the cycle rickshaw to reach from Delhi to Chennai. You've got to match the product that you're buying to your holding period. That's your key. First thing that you do in investing is you decide, when do I need the money back? Is it within 3 years? It is zero risk. It's okay to put that money in a fixed deposit if you're not being able to understand mutual funds. It's fine, because you see, the potential for growth is not that much in 3 years. Between 3 to 7 years, you can start taking a little bit of risk. So categories like conservative hybrid, little bit of equity in that space, still not too much. But as you move towards 7 years, you can start upping the equity component. And anything above 10 years, I would say go all out into equity. And especially those of you who are in your late 20s, early 30s, mid 30s, you have a long runway ahead of you. Why are you thinking of 7, 8, 10 years? Think of 20 years, think of 30 years. Think of forever funds. So a passive fund, a fund which tracks the index, a broad market index, say like the Sensex and Nifty 50, these are forever funds. You actually go on investing and you take the fruit when you want, but you never cut this tree down. You have to rethink the way we think of investing in markets. And I'll tell you what, right now I'm in Delhi. You can see it by the clothes I'm wearing. It's still very cold. But there is this whole chatter you hear around you in restaurants and social groups. So right now, the talk right now is of, oh, I'm sitting in cash because this market is like this, and the market has built in the Modi win of 2024. So I'm moving to cash. And the question that they're unable to answer is, what if the market doesn't fall? And there is a cost to moving to cash in terms of taxation, right? So this thing of booking profits and facing what I call the reinvestment risk is something that people don't think about, because they're thinking of equity as still a short-term way to double or triple money. I'm saying you have to change that mindset, and investing through a passive fund, especially a broad market fund like the Nifty 50 or the Sensex, especially for starting out investors, is a great way, because with these two categories, we can actually do back testing. And I gave you the data. What is the CAGR? What is the average annual return that I see on the Sensex for the last 30 years? It is a 12% to 30, depends on when you do the number. So I'll take a range between 12 to 14%. Okay, 12% to be conservative, 12% average annual return is return that we have seen through all the mess that our economy has gone through. We have still seen that number. So my conversation with you is that when you start investing in markets, you got to do so with your seat belts on. The seat belts, excuse me, of an emergency fund, of insurances, of breaking your goals down into short, medium, and long-term goals. It is this long-term component which you entrust to equity. And passive funds is, honestly, it's a great starting point for most investors, and even for mature investors. I know of many investors who don't want the bother of active fund investing and would prefer the lower expenses of a passive fund, and just this shut it, fill it, forget it approach of allowing that index to do the work. And the second part, so one was the volatility piece. The volatility you deal with by putting on these seat belts. And the second is this unrealistic expectations. The story that I'm telling of people wanting to exit the market and book their profits. To all the people who think that they're very good at stock picking and they can harvest return and then get back into the market. To be honest with yourself, you only have to calculate your portfolio return for a year. And this is the question I like to throw at people who say, oh, I doubled my money in that stock, or I tripled my money in that stock, or FNO trading gave me this and that. My only ask of them is, sir or madam, can you give me your portfolio return for the last 12 months and for the last 5 years? What is your portfolio CAGR? And I have to tell you the truth, I have never till today got an answer to that, because calculating the portfolio return will get home the point that they have underperformed the index. It is very nice. It's probably a sign of what a great guy you are that you bought this stock, which is a 10 bagger, but you don't discuss the stock which lost half its value. So I think take emotions out of investing. It's not about what a great guy or a great girl you are. It is just money doing its work. And when money does its work, you need to have very cold-blooded metrics to measure its performance. And that metric is to take a portfolio return and compare it with the broad market index. Is the work that you're doing at least as well, if not at least substantially more, because of all the work that you put in stock selecting and then managing your portfolio on all that? If that is not being met, then are you not better off in a passive fund? So, and as investors get introduced to categories other than Nifty 50 and Sensex, you have to also look at things like so index funds, of course, have liquidity, but ETFs might sometimes have issues about liquidity. So those second and third order conversations will begin, but almost never is it going to be about the highest return of the market. One argument that I hear a lot of times is that people jump between categories and funds which have done exceedingly well over the last year. So right now, suddenly I'm just hearing PSUs. Because PSUs have done what, 90%, 100% over the last year. But these are last year's return. If you were such a great stock picker or category picker, you should have picked it a year and a half back and then got into it. So you have to again manage your expectations in terms of what is it that you expect from a portfolio return, which is why you never jump across categories. You don't say that today I will do PSUs, tomorrow I will do small cap, and the third year I will do mid cap. It is a portfolio, which means you will split it between large, mid, and small, and maybe a few sector funds. But those pieces of the pie are numbers that you decide today, not as you go along and you see performance of, say, small caps last year, PSU funds this year, and then you keep changing your allocation. That's a sure way to lose money. So even if you're doing passive on different parts of the market, it doesn't matter really. But what you need to start off is with your asset allocation in place, that your first cut allocation will be between debt and equity. Within equity, you need to have an allocation between large, mid, and small cap. And for slightly more seasoned investors, you can add in the sector that you think you are bullish upon, and then have a slice of the pie for that sector. So the story goes that equity is for long-term investors. Long-term investing is best done with seatbelts on. We need to be able to overcome the impact of volatility, which is real on our short-term money. We need to manage our expectations on what the market can return. And I will give you a simple formula, and I will end with this and back to you, Prateek, is that how do we predict? And a lot of people, talk to me about cryptocurrency, and this is the answer that I like to give, that if you give me the GDP and inflation of a country, I know pretty much what the market average passive fund will give me. It'll be GDP plus inflation plus something called an equity premium. So if we are doing 7 and 5 in India in terms of GDP plus inflation, you add that up and you come near a ballpark number of long term what the broad market index will do for you, right? That is how I can predict. But this high risk thing called cryptocurrency or digital coins, I have no way of evaluating. I have no way of saying with this sense of certainty that in a growing economy, my stock market average return, unless I'm China, will grow. Okay, so the caveats can keep coming, but essentially in a growth economy like India, this is how we can predict. And the easiest, the lowest cost, the lowest headache way of doing this is actually just onboarding a passive fund. So long-term investing with commitment, buying a forever fund. Do not be in this rush to buy today, redeem day after, get in the market when it falls. Nobody can predict it, okay? Leave it to the fund managers to predict these ups and downs. They have the wherewithal, they track the markets, they track oil prices, they track the wars. Retail investors like you and me we don't have the wherewithal. So leave it to the experts. And if you are not able to do the work required to choose active funds on your own, or don't work with a financial planner who can then pick the funds who give you benchmark plus returns, okay, returns which are at least 4 to 5 percentage points higher than your basic index, whichever part of the market you're at, you are better off in a passive fund because 1, there's no problem of choice, 2, it is lower cost. So that's my basic messaging to you, that it's responsible, very long-term investing. Back to you, Prateek.
Great. Thanks, Monica. That was extremely, I think, simple and it's very effective. So I'll just maybe take a couple of minutes, take maybe a couple of questions from you. And I think very well said. I think investing should be long term, and you should make sure that you have seatbelts on in the form of emergency funds and insurance to ensure that any immediate needs are taken care of, and then obviously your also retirement is taken care of. So I wanted to ask you about 2 things. One is there's a lot of I think retail investors who keep asking me, and I would love to ask you this question about when to invest. I think should we invest, because we know guys like there is 2 sort of, I would say, parties to this. One is, say, someone like Warren Buffett, who invested 11 And if you ask him his biggest regret in life, he'll say, I wish I invested earlier. And the other one is, people who say that they want to be sort of financially secure, buy a house, buy a car, and then once you're set up, then you can start investing. What's your, I think, a point of view?
I think it's very clear. You just start investing long term the minute you start earning. You don't delay that. So whatever are the goal that you might have in terms of house and car, that can parallelly carry on, but a little bit of your investment is really, it starts the day that you start earning. And to be fair, the organized sector workers, because of their provident fund, and now either it's EPFO or it is NPS, they're already doing 24% of their basic.
Yeah.
My only sad part is that other than the NPS, and even then it's not a full 100 equity, I think NPS still doesn't give you that choice. They keep changing the allocation, so I'm not sure what they're at, but I know for the government employees, it's still capped at 50% equity. It doesn't allow you to go all out in equity the way that, say, a mutual fund might. So, so it really, other than the NPS, and even then it's, I'm hearing a little bit of an audio back in my ear. What is the problem?
Yeah, you can go ahead.
Okay, fine. I think a very simple answer to your question, Pratik, is just begin the day that you can. If you're already part of the organized sector, then you have an elbow room to delaying it a bit, but a little bit of money in equity in your starting in your 20s, even like $1,000, 2,000, whatever loose change in the month you can spare, if you can just salt it away, you will look back 20 years later when your hair is gray and your stomach is slightly bigger, and you will thank your younger self for what you did 20 years ago. That I can assure you. Whatever it is, little bit you can put away, just do it.
Got it. Great. Oh, that's a great answer. Just one more question. I think when it comes to personal finance, does age really matter? If you're, say, 40, 45, should your decision making be different than if you're investing at 2020?
Yeah, definitely. I mean, at 40, 45, you've got about 15 years of your organized sector working life left. Your runway is far shorter in terms of getting your retirement corpus in place, because work after age 58 and 60 is dependent on how skillful you have been to reinvent who you are as you go through life, whether there is a second or a third career waiting for you at this sudden death at age 60. So your goals would be very different. And if you have not done a good job in targeting your retirement corpus, this is that decade, 45 to 55, 60, that you really push the pedal on your retirement savings, because you really have no options left after that. So and also, by the time you're in your 50s, what happens is your children are grown up, they're financially independent of you, which means they've started to earn. Mostly your home loans are over. So your saving capacity has gone up. So that's the time a lot of families are able to salt away 50, 60, even 70% of their take home. And also remember, 50s is your highest earning decade. This is the peak of your career. You are topping out in management. You are at the best place in your career. Your salary will be the highest. So even if you have not started, if you are in your 40s, mid 40s, and you feel that you're underfunded, know that your golden decade of work is right ahead. Your only job is not to get yourself fired at this age, because re-employment is difficult, and this sort of salary level will be difficult. So you've got to just keep it going so that you can harvest the fruits of the last 2 decades in this 50s decade, to be able to salt away for the 35 to 40 years that you have after age 60. And again, for a person who's starting out, their runway is much longer. You've got your 25, 30 years ahead of you. So even very small amounts have the potential to grow into very large amounts. 1, and 2, you have the margin for error. So even if you're trying out a new product or a new asset class, or you're trying your hand at equity, and even if initially it doesn't seem to work, the capital at risk is very small, right? Your surpluses are still small, and you have a long runway to recover from any mishap which happens. So the emotional part of investing is very different. At 45, 50, your stakes are very high. your money is where there's a lot of money at hand, plus you are near that end of the road with your organized sector work. Earlier years, it's you have much more options out there. So that's the way. And again, Pratik, investing it's a lot about emotions. It is about the money, but I think it's also a lot about managing the emotions. So when we talk about investing, I think it's very important to think about the mental state of the people and what age, stage, marital status, family situation they are in when they begin to invest. So the two cohorts will behave very differently according to me.
Got it. Got it. No, great. Thanks, Monica. Great insights. Great to have you on this, conclave, and thanks for your time, and we look forward to having you more often with us.
Thank you. I wish you all a lot of luck, and it's great to see passive funds come to center stage.
Thanks. So that was a very good session. Thanks, Monica, for coming in and giving your insights. We move on to our next session. I think this is going to be chaired by Sejal, who is be very active on social media. I think she's extremely. I think please do follow her on Twitter and other platforms. Very lot of work done in financial education, and today we have a very interesting panel, all women panel. I think I was looking at the schedule today, and it never sort of struck me that for a financial services conference, it's good to see more women than men. It's normally the opposite. So I think I didn't really notice it till right now, but hopefully we'll be able to keep up the tradition. But anyway, I'll have Sejal take over, and she can introduce herself and also introduce the panel, and we can have a short discussion. Thank you.
Absolutely. Thank you so much, Pratik. Am I visible on the screen?
Yes.
Yeah, so hi, I am Sejal Sood. I am a law student, and I was really curious about how, money works, how does finance work? And luckily on Twitter, I got, associated with certain people who work around the financial industry, and I got quite interested. I was really good with social media, so I reached out to financial brands, and I decided that why not help them with social media, investor awareness programs, and also try out certain things around campaigns. So that is something that I do. And now introducing my speakers for today. The first speaker for today is Deborah Furr. She is the driving force behind global ETF innovation and female empowerment in finance. With accolades including ETF.com Lifetime Achievement Awards, Deborah's influence knows no bounds. As a founder of Women in ETFs and managing partner of ETFGI, she is reshaping the industry landscape. Get ready to gain invaluable insights from her wealth of experience on transformative power of passive mutual funds. Hi, Deborah, are you there?
Hi, yes. Can you see me and hear me?
Absolutely, Deborah. Can you hear me?
Yes, thank you for that very gracious introduction. It's great to be here.
Thank you so much, and I hope I get to learn from you as well today. The second speaker for today is Koyal Ghosh. Meet Koyal Ghosh, a passionate advocate for passive investing in women's financial inclusion. With a diverse background spanning top financial firms, accolades like being named India's top 100 women in finance, Koyal is a driving force behind ETF adoption in India. Get ready to be inspired by her journey and learn how passive mutual funds are revolutionizing investment practices for women every day. Hi, Koyal, are you there?
Yeah, hi, Sejal. Very nice to be here.
Thank you so much, and I look forward to hosting you today. And the third speaker for today is Aditi Sholapurkar. Meet Aditi, a trailblazer in finance with a mission to bridge the gender gap. From her early days at Goldman Sachs to co-founding Salt, she's championed women's financial empowerment. Aditi's expertise spans from trading floors to fintech giants, all leading to her passion for passive investing. Get ready to be inspired by her journey and insights on how passive mutual funds can be every woman's best friends. Hi, Aditi.
Hi, so excited to be speaking to you today.
Thank you so much, and welcome to the panel. So, we've noticed that, more and more women are getting invested in the financial sector. even when I remember doing a project in my school and I was very curious, right? How does money work for women? I realized that a lot of women who are well off as well, my school teachers, right? I asked them that आपका पैसा कौन manage करता है? Ma'am said मेरे husband के CA and my husband. And I was shocked. These are educated women. And I think I was 17 years old. After that, I went to Didis and Bhaiyas. I said, आप लोग investing करते हो? They said that, because of high marginal propensity to consume, हमारे पास पैसा ही नहीं बचता है. Right? MPC is a economics term, but they said पैसा बचता ही नहीं, invest क्या करें? So I realized there's a major gap, right? There are products available. These people might not know about it. And I think there's nothing better than index investing. So now getting to our questions. So I will be asking questions to each speaker alternatively, and we start with Deborah. So Deborah, you've been a prominent figure in the ETF industry for many years. How have you seen the landscape evolve, particularly in terms of female participation, and what opportunities do you see for further engagement? Deborah, I think you're on mute. May I please request you to unmute?
Sorry about that. So that's a great question. And I think if I go back to the early days, the ETF industry is turning 34 years old on March 9th this year. So the first ETF was listed in Canada. When we think about that, I got involved with the ETF industry in 1997. So there were 21 ETFs and $8 billion invested in them. Many investors said, are you going to pay me to use these ETFs? So are there inducements to use the ETFs? And that was never the case. So many people said, I'll never use them. We also saw that many people said, I'm an active manager, I will not use these products. As time progressed, what we found was many people realized that it's hard to find active funds that consistently deliver alpha. If you look in general, 7 out of 10 active funds do not consistently deliver the alpha that they're saying. You're paying much higher fees, which detracts from the performance of your fund against the benchmark. And we also saw that people started to understand what ETFs are. It's kind of like the first time you're told about something, you don't know it, so you're a little reluctant to even think about it. And so as knowledge increased, people realized that the benefits of ETFs are instant diversification. And that is really important to retail investors. So rather than putting all your eggs into one thing, you are able to get exposure broadly. So if one security has a bad day or a bad week, you are diversified, and that has little impact on your overall investments. ETFs are transparent, they're cost efficient, and you also found that they cover many different indices that people know and want to get invested in. So as we progressed, we found that increasingly regulations changed that prohibited the payments to advisors to sell products. So as we developed this level playing field, we found that people became aware of ETFs, they embraced them as a tool or solution, and they started to use them more and more. One of the unique benefits of ETFs is they're a very democratic product. So you find pension funds, sovereign wealth funds, hedge funds, asset managers, advisors, and retail have access to the exact same product at the same annual cost. So you can invest in very small sizes in a cost-efficient fashion. And so what we've seen over the years is, historically, if you look, it used to be that in a relationship, the men and women, often the men was dictating how to invest, where to invest, engaging with the advisor. Over the years, what we've seen is it's very important for financial advisors to speak to both people in a relationship and to speak to the children. And we've seen that women tend to live longer than men. And so dealing with women, helping them to understand how to invest in a way that makes sense and treat them like knowledgeable and capable people is very important. So we've seen a real change in the way advisors think about engaging with females. We've also seen that there's many now high-profile female portfolio managers that women can look up to. There's also ETFs that are investing in women-run businesses, and we find that companies that are more diversified and having women and men at different levels of the organization provide better performance. So there's a lot of drivers that are influencing the investment by women, as well as younger females and even children. You find that you can open an account for a baby these days and put some investments in a tax-efficient fashion. So we're definitely seeing that women, especially younger ones, are investing more and more in index because they realize that you can generate alpha by getting the asset allocation right, where it's harder to do it through active funds that don't consistently deliver alpha and charge higher fees. So the participation of women across all of the different ages is increasing, and it's also changing around the world.
Absolutely, I completely agree. I started my investing journey earlier with stocks, but now I've moved to passive funds because that's more reliable over the period of time, right? And also, when you earn your own money, you're more careful with it, right? Now, going to our second speaker for today, that's Koil. So, Koil, given your unique experience in promoting passive investing in India, what are challenges that you've encountered with getting more women into passive investing?
Sure. I think it's good to hear, Sejal, that you started at an early age and also that you started with passive. So you'll be a good example for more and more, younger women to be starting the passive wave. So I've always been an advocate for passive investing, and in the past, I think 15 years, where I was associated with S&P promoting indices in India, I think that's one thing that I've been constantly doing. But one of the things I started noticing, not only was, I think when I joined and I started promoting index investing, it was a premature time. Debbie spoke about how globally the landscape started changing from somebody asking for kickbacks for actually investing in ETFs to moving into a much more developed space where people realize the cost effectiveness of it, right? I think India is going through a transition where they are understanding the power of passive investment. Pratik just spoke that the passive space has grown to 17%. When I joined the industry, it was less than 1%, right? So it kind of has grown now. But one of the things that's also changing is the way money is accessible to women. If you're talking about the Indian space, there are research and reports which are now saying that there is more money in the hands of urban Indian women. This can be attributed to the surging education levels, which is a complete game changer, right? So now the number of girls enrolled per boy ratio has gone up. As per the ILO, that's your International Labor Organization, and some statistical organization, the Indian women on an average, who used to earn around 48% less than their main counterparts in 94, this gap has reduced to 28%. So, your accessibility again increases, right? Even when it comes to bank accounts, the ticket sizes have gone up by 10%. But one of the core things that even Monica mentioned was emotion. Now, one of the things that is a major hurdle when it comes to investing and women is that sense of I think the imposter syndrome, that this is not something I can do. I mean, that runs across educated and kind of people who are currently educating themselves, right? People in high positions, etc. The very thing that somebody mentioned, that I don't, you have these salaried women who say, I don't know, I don't think so, I can invest, my husband or my CA does it, why can't you do it, right? So this is lack of confidence. A bit of it can be attributed to knowledge and awareness, but today I think forums such as this and a lot of other forums are kind of building out. There are platforms that are completely dedicated towards encouraging and building up the knowledge base for women. And I think there is some pre-bias that is, it's kind of legacy bias that, oh, men do a better job in this. So I think there are a lot of hurdles, and these are the challenges. But these challenges are not only this. I mean, I heard this word alpha a lot, and a lot of people say that, oh, there is alpha in, better alpha in active investing. There are two forms of investing. For maybe some, for the audience who may and may not understand, there is active and there is passive. Active is something where you're directly going in and investing in stocks and shares, or your active mutual funds, where your fund manager is making active calls and selecting stocks based on their expertise. And then you have the passive, which, as Monica explained, was the index-based fund. So you just replicate the index. If your Sensex has 30 stocks, you will be replicating the index. And if you're investing 500 rupees, your 500 rupees will go exactly in the ratio that the Sensex or the Nifty has, right? So these are two options that people have. But there's always been this debate between active and passive, this alpha, but one has to understand that both can be used very effectively when it comes to creating your portfolio. Now, if you have that acumen to sit down and analyze the market, go through stocks, go through the fund management performances and see how they're doing, how the stock portfolio looks, then an active approach is very good. There are people who are very, very good in equipped to do that. But when it comes to women, like I said, there are a lot of these things where women like to be very particular about where and how they spend their money, right? Sejal, you told me that now that I've started earning, I'm become very conscious to where I put my money in. I think that's a feeling that all women, I would feel, associate with it, right? So I think that's where that sensitivity to risk management, if I can use in the financial term, or it's like being conscious about where your money is going, comes into it. So I think that's where the passive space helps you, because it's an index. You get to see it day by day. You see how the index is changing, and a simple thing like a market-based return like Sensex and Nifty, you see it changing its counters every day. Whatever you invest in there, you know that whatever that return is, it's a similar kind of return you'll get. So it's, the one word for why people should go into passive, it's simple. So I think the challenges that women face are all, I would feel, is emotional, but I feel that the trend is completely changing and women are more and more taking that up. I think the audience having more women is a testament to that.
No, absolutely. I completely agree. And these traditional biases do affect the mindset, right? I remember talking to certain working women in my family, and they're like, "Nahi, mujhe finance samajh nahi aata hai." And at the back of my head, I'm thinking, you're earning money, you don't understand finance. What's the point? So basic understanding is still important. You hand it over to a mutual fund, but you should know how the car runs, right? Have a driver do it, but know how the car runs. Now coming to Aditi. So, Aditya, you're running a startup by the name of Salt. I am a part of the Salt financial fitness community as well, and I am very well acquainted with Shinjini. So, the question I have for you is, there is some background noise. Can I just request?
I can hear it too. Yeah, I
Yeah,
don't know.
can I just request there's some background noise, please? Thank you so much. Yeah, let's get back to the conversation. So, how has your journey from traditional finance roles to co-founding Salt, shaped your views on gender investing in finance, and particularly in the context of, passive investing? Because women have very, like, I think housewife, there were trends when this demonetization happened. A lot of women hid money at home, right, in the kitchen, under the bed, and all these places. And then they realized there's so many notes at home. That happened to one of my family members as well. So what have you noticed in these, what are your observations?
No, that's a really interesting question that you asked me, specifically because Salt was a huge learning curve for me, right? You mentioned my background, but just to drive home this point, I started out my career as an equities trader and then a FIG trader, and across the three lovely places where I worked, which was Citi and BAML and then Goldman Sachs. The vocabulary of money is very different, right? When you're in a trading floor, when you're in a dealing room, money is very different. The people you're talking to are, hedge funds and large investors. And so money doesn't have a human face. And, moving into sort of the retail space, consumer fintech, and then starting Salt, the biggest difference that I think the biggest learning for me was understanding that financial decisions and money decisions are two very different things. Financial decisions are optimizing, right? Like you mentioned in your own journey that, oh, when I started out, it was stocks. And a lot of people start that way, right? Like that's the whole concept of the midwit paradox. When you start, you're like, oh, like this, that, maths, Excel, historical, in and out, right? I think Monica alluded to that as well. In the chat and the questions, I can see people saying, what's better, Nifty 50 or Nifty 500? And, interestingly, if you look at it from, 2006 onwards, there's like a nothing difference in the return, right? Money decisions are decisions that are more reasonable than rational, and they aren't built on optimizing, but they are built on optimizing for you, right? And your personal context and your familial context. And so they're more about wealth creation. And wealth creation sounds like a very privileged term, but it's actually applicable to every single person. And when we started Salt, a lot of people said, oh, wow, so this is like an impact thing you're doing, gender diversity. And no, the answer was no, right? Our goal was to just increase the household wealth of Indians. And the best way to do that was through women, because women are the single largest determinant of, household wealth. And there's something very crazy about India. When you look at it statistically, you realize that we are an outlier in a negative sense, right? We're very poor when it comes to wealth creation, because the ratio of wealth created to income generated, even for the top 10% of earning bracket, is really an outlier. And India also happens to be really, really poor on the gender parity index. And so a lot of these things happen over generations, because women have been kept out of this wealth creation loop. And with Salt, and I'm very proud of saying that, most of we have amazing, wealth platforms in India, amazing fintech apps. And fortunately, more than 95% of that consumer base is men. Because of the way we built Salt, we started out with a 70%, women base. And so we've had a chance to observe how women assess risk. They're fantastic at it, by the way, and how women make decisions. And the fundamental thing that drives women is not risk aversion, but risk awareness, which really fits in perfect synchrony with passive investing. And let me explain what I mean. There's this whole popular trope that women are risk averse, and that's so sad, because the truth of that comes from this actually very well researched white paper, which essentially says that men have higher levels of cortisol, which means that in any environment, around any stimulus, they will optimize for high value, lower probability returns, because they're driven by that high cortisol, right? Whereas women assess their surroundings and will always optimize for higher probability, even though lower value rewards, right? And if you really look at this is how good fund managers think, right? And that is the essence of passive investing, because you're essentially using tools like diversification, time horizon, even the value of, not paying that extra 50 basis point of fees, or, 100 basis points of fees over a 30-year period is tremendous, right? And so there's almost this natural fit between what women stand for and the way they make money decisions, not financial decisions, and the way passive investing is structured and built.
Right, absolutely. Thank you so much for this insight. And I do, what I realized was, until my father was paying, I was doing stocks. But once I started earning and he said, I won't give you money you're earning, I started with mutual funds, because then you realize that, okay, now there is no excess cash available. Let the expert do the job. So I think that is a good choice to make. So Deborah, coming back to you, the question I had was that, could you shed some light on the trends or patterns that you observed regarding female investors, their behavior and inclination towards passive investment strategies, like some core challenges, what are the trends, and like just observations?
Well, I think everyone else who's already spoken has shed some light on this. What I think makes it useful for women and all types of investors is that it's relatively easy to understand an index. So you can go and look at what's in the Nifty, the Sensex, if you want to invest in the S&P 500. So I think the awareness of what you're investing in has been a significant benefit for index products. And I actually like to use the word index as opposed to passive. And the reason for that is, when you think of passive, it makes it sound like you're not doing anything. You can be active in how you allocate your money, which will help you to generate different returns. So by being diversified between equity and fixed income, or different types of equity exposure, maybe to India, to the US, to other markets, really helps that greater diversification. So index just better represents you're using index exposure to get your asset allocation right. And so what we've seen is that increasingly there have been tools developed to help women understand investing. So whether it's robo-advisors or brokerage platforms or other things dedicated specifically to women, and even organizations. I mean, we just heard about your colleague who's set up something to help investing. So it is making it easy for women to understand. I think in many cultures, talking about how much you earn, talking about how much money you're trying to invest is often seen as taboo. And that's been one of the challenges that we've had to break through in terms of getting women comfortable to speak about questions. And part of it is also giving them the vocabulary to be able to articulate what the questions are, because often they don't know what they don't know. We've made huge strides in developing different portals, networking groups, and websites that help people make these decisions. And people like your colleagues on this panel are helping to facilitate making it easier for people to understand how to ask those questions and how to invest. And I see that trend really growing globally when we look at, one of the silver linings of COVID was people sitting at home paid attention to their finance a lot more. And so if you look at many of the stock markets, the number of investors that were investing in 2021 increased significantly. In the US, 15% of investors in the market were new investors. We've seen similar studies come out from Australia, in Canada, other geographies around the world. So I think people have become more aware of the need to think about savings and investing, whether it's long-term or short-term, even saving and putting money aside to take that holiday that we all dreamed of during the COVID lockdown. So I think things have really evolved in a lot of ways, and all for the better from my perspective.
Absolutely. And can you throw some light on techniques that are specifically being used to encourage more female investors? Because as we were discussing, right, there's an inherent bias, and also women investors, sometimes when they begin with the markets, they're a bit hesitant, right? So any specific techniques that are being used to encourage more women?
Well, I think it's like what Koi and other people are doing is creating groups to target women and help them feel they should be included. So we've seen initiatives happen, many in the US. You've seen senior women who have left high-profile jobs and set up portals and groups to target women. We've seen products that are set up to highlight women and the benefit they've had on companies. And so I think there's so many different robo-advisors, there's brokerage platforms. We've set up as something I've actually helped to set up is called Women in ETFs. And so that would be an organization that also thinks about women in their careers, because to save money, you need to earn money. And so it's very important to be able to help women get good jobs, to be able to manage their career and advance. And so the only way you really, if you do end up, and we've seen many companies talk about, job cuts, it's much easier to find a job if you know people, because if I know you, I'm more likely to recommend you or hire you. If I don't know you, I might not feel comfortable employing you. So I think the whole idea of connect, support, inspire, and also to encourage men to be allies and help women is a very important thing. So I think Women in ETFs has just turned 10 years old. We now have over 10,000 members. Koi is one of the people leading a chapter that's been developed in India. We also have chapters in Seoul and Hong Kong and Japan, as well as across Europe, Middle East, Africa, in the US and Canada. So I think it's getting women together to be able to discuss their career, savings, investing, and also, just generally, how do they improve the investing space for all types of people around the world?
Absolutely. Thank you so much, Deborah. So coming to Koel, right? So Koel, what's one advice you'd like to give to women who are hesitant to start investing, and how can passive mutual funds serve as a gateway for the same?
Well, like I said earlier, like it's one, keep it simple is always the first word. And in my recent engagement that I have currently with ETF Junction, I have kind of also created, like Debbie mentioned, how we kind of creating more education and support around. So we launched an education initiative called Her Money Junction, which was just about encouraging women to have those discussions and talk about what is it that makes them uncomfortable, so that we can resolve those, right? Very surprisingly, Sejal, you'll be I had this one conversation with a very, very successful banker. She wins awards. And the surprising thing was she said, you know what, I don't even have my own individual account. It's all joint accounts, right? And so technically, while she said I don't have a problem with it, she doesn't have any individual or independent, investment in her name. Clearly, that was something that was egging her. So these are things that, a lot of women, maybe even in this forum, maybe feeling like they associate with people who have taken sabbaticals and don't know, what to do because they at some point of time were, kind of very well equipped and earning their own money. But these are things that, are developing. So the dialogue with women is becoming, very, very critical. I am sure Aditi will also realize that when you start having those, discussions or conversations with women, it actually becomes very basic. When I try to explain what a passive investing is, I have to literally explain it somewhat like this, and I will take that minute. Like, it's like if you have, for the sake of Debbie, I will use a Christmas, kind of example. So if you have Christmas, because otherwise, Debbie, we also have Diwali as a big celebration in India. So I use the context of Diwali. And, the way I explain active and passive is literally like active is when you go to a sweet shop and you pick your own sweets and you put it in your boxes. And for Christmas, it would be choosing your own chocolates of a certain mix. But if you talk about passive or index investing, which is also a lot of people, here we've been using index investing. A lot of people are confused. What exactly is index investing? Basically, it is when a Haldiram's or a Lint, etc., has a pre-packaged box and you just pick it up, right? It's easy. So in context of when you're talking about passive investment in our markets, it is about picking up that basket of stocks which is pre-made, preset. It has an entire people talk about returns when it comes to investing. You have an entire you don't know how it will perform in the future, but nobody does. But you have an entire historical performance, which of course active also does. But an index is actually a representative of how a country would do, how a theme would do. Monica spoke about PSUs. Sometimes you may not understand what is a PSU. You may not understand what is a large cap. In our audience, we may have some people who may be absolutely aware of how the markets work. And you may have been having some women, he'll be like, what are you talking about, right? So when you don't understand that, when you group a market proposition or an investment proposition into these buckets, it becomes very easy for anybody, not only women, even maybe men who are initially starting their investment journey, to just pick up those baskets, right? And they have those standard performance. Now, if the market itself corrects itself, the index will also correct itself. So if you are saying, okay, how much will an index based investing give me returns, it will give you a return which is similar to what the index has been performing. That's how it's going to go. So if you kind of align yourself to thinking that, okay, I'm going to be investing in indices because I want index based returns, you will get that. And a lot of people spoke about alpha. It's not that you cannot get alpha, is just that additional return over a certain benchmark return or a return standard return. So if you say a Sensex or a Nifty represents the Indian market return, which is, say, for example, 15%, just an example. Now anything over and above that is termed as alpha. Now that you can get even through another passive product. There are something which are called as smart beta or factor based products, which are nothing but you take certain fundamental factors like price to book or sales or profitability, and you create a basket which filters those stocks. So it kind of will say, okay, it'll be a certain profitability above a certain amount. So automatically the stocks which are slightly in a different profit trajectory will come into that space. So that may obviously, you are measuring the index differently, so the return is different. So like I think Debbie also was saying, that you can actually create a complete portfolio of passives as well. You don't have to kind of toy between active and say that, okay, if I don't understand the market, I don't have the capability to sit down and research. To be very frank, Sejal, when we are working, we are also not tracking the markets on a day-to-day basis. So what's the simplest way? I mean, one thing we are talking about systematic investment, right? A very systematic investment into passives, and you can just go off to sleep. That's how simple it is.
Absolutely. Thank you. Thank you so much for those insights, Koel. And I completely agree. You give that example of sweets, right? So when I explain it to my friends at college as well, I tell them thali hai, right? Thali mein pehle se sab kuch ban kar aaya hua hai. So that. But now, as we're running slightly short on time, I'll quickly run to Aditi. So, Aditi, you've been building Salt, right? And you must have noticed there are certain barriers that women might be facing from a fintech's perspective. So, how is Salt bridging those gaps, and where do you see, like, in the next 5 years, how many, like, how can we get more women active into passive investing? So, active into passive investing.
Uh, no, fair. So, interestingly, and I think Deborah mentioned this point about vocabulary. Right in the beginning, when we were sort of laying the groundwork for Salt, we realized that vocabulary is the single biggest deterrent. It is also the single biggest tool, you can give anyone, but specifically women, to sort of reset this balance. And it was really interesting because we used to do these like really long interviews with women, and just the discovery was insane. And we were like, okay, we have to find a way to productize this. So we built this psychometric. We called it the money personality test. It was really cute and fun, so it went viral. But I want to talk about some of those learnings, because I think even within us, we carry a lot of biases around what we think holds women back versus what actually ends up holding women back. So, 250,000 people have, done that psychometric, and our learnings were so conclusive. For example, women scored pretty much the same and sometimes higher than men on comfort with financial terminology, but they scored much lower on participation in financial conversations. When you looked across both genders, there was no discernible difference between the propensity to make financial decisions, or even the relative levels of satisfaction with the outcome of financial decisions. Yet women had a lot more reluctance when it came to using apps for investing and so on and so forth, right? And so that sort of made us realize that the problem here is definitely not a supply side problem, right? Amazing products exist. Passive investing is a fantastic product. The problem is the delivery mechanism, right? If you don't make this understandable, approachable, relatable, and if you don't give a woman the vocabulary. So, for example, a very typical issue that we ran into was people not understanding the concept of annualized returns, right? So we had a lot of people asking us things like, oh, on my, XYZ bank FD since whatever 3 years back, I've made like 12%, and I invested on your app and I've made 3%. And yes, of course, because that was 3 years back, and you've just been invested for a year. Similarly, basics of compounding, right? Not even rocket science, but just basics of compounding. Invest a rupee, double it every day, or take 1 million. That very sort of popular, social media problem. So I think with Salt, our goal has been to primarily solve the confidence problem, right? We've built a fantastic execution platform. We've done a lot of things, but with every single woman that starts off with, oh my God, this is too intimidating, to, oh wow, I now feel comfortable, the difference has been giving her the right tool for getting started, giving her the vocabulary to understand and measure correctly how she's doing, and then showing her, sort of a way forward and fitting it into the context of her needs and her lives. Like, we love talking about SIPs, but one huge learning we had during SALT was not everyone is salaried, right? And we have a lot of women who are freelancers. So systematic investments honestly aren't the best thing for them. It's periodic lump sum investments, right? And great, if that's what works for you, do that. Like they say, the best diet is the one that you're going to follow, or the best exercise routine is the one that you're going to be diligent with. And so, yeah, these small tweaks to just make money make sense for you, right? And not your neighbor, not XYZ. I think that's been the single biggest needle mover for us.
Absolutely, Aditi. Thank you. Thank you so much for sharing these insights, Deborah, Koel, and Aditi. I think forums like these, bring more representation where you see that, more women are active with their own finances or are, leading fintechs or working around money. That just inspires more women and realize that, okay, yeah, if she's doing it, why can't I? So representation does matter and does encourage more women. Now there is a new panel that's coming up. It is being led by Mr. Anant Lata. I will just quickly introduce him. So Anant is a distinguished academic. He's one of the top finance creators in India. Anant is the founder of YouTube's most viewed stock market channel in 2022, Invest Aaj for Kal. Through his channel, Anant has imparted free financial literacy to more than 25 crore people in India. So welcome to the panel, Anant. I hand it over to you.
Thank you so much, Sajal, and thank you so much for such a sweet introduction. And I hope you guys are having fun and we are all set to start a new panel. Firstly, I would love to introduce all the panelists. Firstly, we have Mr. Pratik Oswal, President Passive Mutual Funds at Motilal Oswal AMC. Before this, he was heading operations and finance at a Series A fintech startup at San Francisco. The company provided automated wealth solutions to investment advisors and managed over 400 million of assets. Next on the panel, we have Varun Gupta, who is CEO of Grow Asset Management with a career in finance industry spanning over 14 years. He is alumnus of IIT Madras and has background in various aspects of mutual fund sector, specifically technology, compliance, and operations. And we also have Bhuvnesh with us, who has been working with Zerodha Broking Limited for over 6 years, looking after all the products related to mutual funds, NPS, and fixed income. He's involved in fintech investment through Rain Matters as well. So Pratik, my first question goes to you. Firstly, everyone, welcome to the panel and very excited for this complete conversation. My first question to Pratik, as a manufacturer, what do you feel why passive mutual funds are important for investors? And to start off, what do we actually mean by passive funds?
Thanks, Anand. Glad to have you here, and thanks to Bhuvanesh and Varun. Thanks for guys for being here. So I'll just start with the first question. So why passive? I think if you look at India today, we're still very underpenetrated in terms of number of investors that are investing into mutual funds or into equities. We believe that for us to really see an influx of maybe millions, crores of investors coming in over the next decade or so, I think there needs to be some element of simplicity in the mutual fund space. Today, I think for most investors, choosing between like a large cap fund and a small cap fund is very tough. I think there's so many options out there. So we believe that with passive funds, things are very simple. You don't have to worry about performance. Costs are very low. And what we've seen over time is that the returns that passive funds drive are almost the same than other mutual funds. So I think it's the simplicity aspect that really stands out when it comes to passive funds. And I do believe that as and when we grow as an economy and there's more and more investors coming in, we believe that passive funds will be a huge part of our people's portfolios. Just as it has in the West, if you look at the US, the mutual fund industry specifically, more than 50% of the AUM in mutual fund industry is ETFs, index funds. So we believe that, I'm not sure if it'll happen in India, but if it happens, I think a lot of the AUM will come into very simple funds. So I think it's simplicity, what we're trying to sort of achieve out here, and hopefully, passive funds are seen for that characteristic.
Interesting. Thank you for setting the context right. Nextly, I will move to Bhuvnesh. Bhuvnesh, a very similar question to you. How do you see that an investor should look at passive and active funds in their portfolio? And also, should we keep it like active versus passive, or you have a different opinion?
No, I think this entire distinction between active and passive, I don't think most investors should bother about it. At some level, it's counterproductive also, I think, adding too many labels. So similar to whatever Pratik said, right? Like if today, for example, even in passive, it's a problem. Like I checked the numbers before this, there are 380 passive funds. Even if I was an investor, I wouldn't know what to do. So the choice is a problem. So if somebody thinks about their first investment, you ideally want an environment for that investor where he doesn't really have to worry about making the right choice, the wrong choice, because we see it day in, day out. Right? Like if somebody comes, he has his first 500 rupees, 1,000 rupees. The biggest problem he has is, if I put this 1,000 rupees, will I get 800 rupees back? in a month or so and so forth. So ideally, like as manufacturers, even as platforms, I think it would the responsibility for all of us is to create an environment where we make it as simple as possible for that user to make for that customer to make his first investment. Which means if we were to give him a fund which has the top 100 or 500 stocks, whatever it is, you could use an analogy and tell him that it's like going to a market and buying everything and not really bother about what to buy. So it's a simple story that works for him, and you don't really have to make it more complicated. Now, if that investor, so the biggest problem for us is getting people into the market. So if you look at the numbers, I think the folio numbers are misleading. We just have 4.2 crores active unique mutual fund investors. That's it. So if that is the problem, if you assume getting more people into the market, like Pratik rightly said, you need to make that first choice simple. Once you make it, you can give him active, passive. He'll do it on his own. So you don't really have to worry about it. Investors are savvy enough to make their own choices. But I think passive funds get people into the market. I think that's the biggest thing that's going on for them. All the other technicalities we can get into, but I think that's the biggest factor.
Interesting, very interesting perspective. I am getting a question from what you actually mentioned. Question is, आपने कहा कि there are a lot of options now in passive funds as well. We say that as an investor, you should move to passive fund because especially if you are know nothing investor, you should not put your brains into the market and you can directly choose passive and enjoy your wealth creation journey. But now since we have a lot of options in passive, how should we go about it? Because if I was to do selection, why won't I let my fund manager do the same for me? Maybe Varun or Bhuvnesh, you guys can take up the question.
Varun, you want to go first?
Go ahead. Follow up to yours.
Yeah, maybe Bhuvnesh, you can take up this question since it was your conversation.
Yeah, sorry. So I kind of disagree with the statement that know nothing investor. Like if you know something, you'd come pick a passive fund. I think that's the smartest thing you'd do. You have tons of data. I think without getting into the numbers, it's become increasingly clear that across segments, most other active funds have a tough time keeping up the benchmark, so on and so forth. So I think, as you rightly said, it's become a bit of a, for the lack of a better word, I hope other people don't get offended here. It's become a case of product pollution if you think about it. So if that's the thing, I think, so far, I think all the AMCs have done a brilliant job of giving investors a wide menu for them to construct all the funds required for their goals. But now I think the question is, how do you put them in journeys where it's easier for investors to make the choices, which means building better investing platforms, building solutions. Like, for example, I think I remember speaking to Pratik when we were launching his fund of funds. I think those are all brilliant solutions. It makes easy for investors to not really worry too much about whether am I making the choice. I keep going back to the word choice because I think that's the one thing I see. Whenever I speak to users, I said, buy me kya karo? Like I'm really scared if my money will remain or I'll see like a red PNL starting from day one. So I think if we communicate the right way, saying that you are getting broad market exposure at low cost, both domestically and internationally, and if we communicate numbers without using fancy words, up in the sky, I think investors will get it. If you look at all the numbers, right? Like I think we were at 6% individual investors in passive AUM. Now it's 20%. Now this is only index funds, by the way. I'm not even considering the ETFs, which EPFO numbers skew this thing. So if you consider individual numbers as a true proxy for adoption by retail investors, it kind of shows. So because we've all been saying the same thing, low cost, you're getting the entire market. You don't really have to worry about making the choices. You get, over the 15, 20 years, you get top quartile or top decile performance. If you just do this, it's at some level, it kind of shows if you just go by the flows. And also,
Makes sense.
We didn't have a single month of net outflows in index funds. And I think that's phenomenal because I've been following this story since 2016. Nobody really cared about these things. Nobody really bothered. Nobody sold these things. It was a pure backward, and it kind of shows. I think it's just that right messaging, the right environment for people to make the choices. I think that's a really, really good starting point. I hope that answers the questions.
Makes sense. Makes sense. Absolutely makes sense. Varun, a very interesting question for you. A recent study done by MO shows that passive funds investing is on rise among investors. What's your take on this, and what do you think is the biggest reason of suddenly a lot of investors investing in passive funds?
Sure. Hey, thanks, Anand, for the question, and Prateek and Bhuvnesh, great to hear your thoughts as well. See, I will try to, not just to that question, I'll try to cover up a couple of points, and it's in, correlation to what Prateek and Bhuvnesh were talking about. See, first of all, we don't think of passive versus active, like the previous question. I think as an industry, we have much uphill battle to fight against the other investment classes, rather than to get, start thinking about what is happening in our own active versus passive for now. And from a passive perspective, see, this is passive as a product solve multiple problems for different investors. Let me take a step back, right? See, at Grow and at Grow Mutual Fund also, what we do is we always think customer first, right? That what is the customer thinking, what is their need, and that has helped us solve a lot of problems. So if we look this problem at the same level, there we believe that there are different type of mutual fund investors, which and I'm yet to come across an investor whose needs or the way he should invest is exactly similar to another one, right? While we see very different scenarios right now that many investors are investing in the same fund or trying to chase returns, but if you really get down to doing the the asset allocation for them and doing the investment strategy planning for them, it will differ differ varyingly across the different type of investors. Now, what has happened so far, so what I mean by this is that every different types of investor will need exposure to different types of passive funds in different journey during their investment journey. One of the easiest example in which Pratik also pointed out was passive funds are the most easiest ones to start off with, right? In one of I was reading the MO study which you guys shared. More than 75% of the investors invest in their own theses, right? They want to get comfortable where they're investing and they just don't want to follow what others are saying. That's a very, very huge, example of why passive investing will continue to grow. And numbers also suggest this. I was looking at the numbers after that study. Passive number of folios in just retail investors have grown from 4.5 lakh to 50 lakh in last 4 years. Number of folios in index funds, right? It is a growth of 14x. Same with individual funds also, individual investors as well. It is now at 60 lakhs folios. If you look at the AUM, it has now almost touched 1 lakh crore only for individual investors in index funds. This is a growth of 21 times, right? So the AUM growth has been faster than the folio growth. And this is unparalleled to the overall mutual fund industry, which has grown by about 2x in the last 4 years or so. So, and that is largely driven by new investors who are coming into the category. For them, it's become easier to understand the passive funds, and that's why they go ahead and invest in the passive funds. But again, coming back to the point which I was saying, that passive funds, I very firmly believe that it's not only for the people who are starting to invest. There are, as per your investment need, you will need, or you might decide to take an exposure to a certain type of passive fund, depending on where you are in your investment journey.
Thank you for setting the context. I think you covered a lot of stuff, especially the data which you were covering was quite insightful. Next, I think एक ऐसा question लेते हैं which all of us can answer, and it's a very important question. We still have a lot of myths around passive investing. Probably all of us can cover one of the myth and debunk it as well at the same time. So, Pratik, let us start.
When it comes to so I think one of the myths that I see is, and there are a lot of myths, is that passive investing is for beginners, which is true actually. I think it's the simplest fund that you can buy to start your wealth creation. So you don't have to go ahead and select between the 5,000 options. Passive funds make it simple. But also I think it's not only for beginners. If you look at our client, so we have a huge client profile, and I'm sure we see that there's a lot of adoption happening for the institutions, family offices. Some of the smartest investors in India are also adopting passive funds in a very big way. So I do feel that it is more to do with asset allocation as opposed to fund selection. I think what we're seeing, say, for example, when I used to be a wealth manager in the US, and there obviously passive funds have been around for over half a century. The first fund was launched by maybe Vanguard in the 1970s. So it's been almost like half a century, and I think it's been 50 years. So either there's nothing like active one or passive one. Most portfolios have a mix of the two, partly active, partly passive. So I do believe that what people are thinking about passive is more about having an allocation to passive as opposed to starting with passive. What people are saying that you should ideally have maybe some part of your portfolio, maybe 20, 30, 40, whatever is what the customer needs and wants is should be something which is stable, invested for 10, 20, 30, 40 years. I think I keep telling investors that if you are a say 35, 40-year-old today and you're looking to invest for your retirement, say 30 years, what fund are you going to buy? It's very hard for you to select this fund versus that fund. If you can just buy a simple broad market index fund or an ETF, you're not worried about performance. Costs are very low. It'll probably get lower in the future. So I do feel that I think it really I think an allocation of passive is what I think the world has adopted, and it will probably come to India over the next decade.
Bhuvnesh, maybe you can go with the second myth. And till that time, to all our viewers, family, if you have any question, you can put it out in the Q&A tab. Probably we'll cover it towards the end of the discussion.
Okay, I have two, but I'll go with one. I think my personal favorite is this passive is not for India because India is a less developed country. There's oceans and buckets full of alpha everywhere. I never really understood the logic of this. I think maybe people were saying this because there was funds used to the degree of outperformance has gradually reduced, so on and so forth. Maybe that's why they're saying. I don't know what that means, because this is a simple. I mean, I'll keep my answer short. It's a math problem. Regardless of what you do, you're at the 50% mark just by virtue of just owning everything. So it's whether you're in, I don't know, some less developed African country or in India, the math remains the math. So I never really understood this less developed, more developed, so on and so forth. Having said that, I mean, some people have this, they have a limited point saying that over a period of time, all those informational asymmetries, whatever you have, you reduce. But I think, just to close the loop, this is a silly argument. The merit for passive funds is not really whether our GDP is big or small. It's math. You're owning a large chunk of the market and letting the market do your job for you. So you don't really have to look at GDP and per capita income and then decide whether you're getting to active funds or passive funds. So yeah.
Interesting and a funny one. Varun, maybe you can go next.
Thanks, Anand. Sorry, I have a lot more myths to cover. So, but I'll still try to keep it
We
short.
can surely revisit the complete round again.
Sure. See, I'll start again back from from what we understand about the mutual fund investors. So when way back, like in early 2000s or 2010 types, when people most of the Indians retail investors have just started investing into the mutual fund category. Many investors were trying to do a very long-term investment in mutual funds, right? Do it and it will go on for 20, 30 years. And that's the right way to invest also, all of us would believe. But over the course of time, the way you start investing in mutual fund has the way customers perceive mutual fund has changed. There is a new category of young investors also who have come in, whose time horizon is not 20, 20, 30 years, but they are looking at more 3 to 5 years, right? And from that perspective, I'll try to say, we visualize that there are 2 to 3 myths which are very prevalent in the market. First is, and foremost, which I understand, first is of course what Pratik covered, that it's only for beginners. But second is कि index investing बहुत boring है, right? कोई मजा नहीं आता है, right? You are just हमको डे में ही पता चल जाता है कितना NAV grow करेगा. You just put in money, you're waiting for the economy to grow, or you're waiting for the certain sector to grow. And then it's just boring, right? You are not really you are not doing your asset allocation, you are not selecting funds on your own. In a way, I think we as an industry also are to be blamed, because we have not really, except maybe 1 or 2 AMCs, not a lot of innovative products exist in the passive space. They have just started to come, and 75% of the AUM exists only in the five massive categories, which is Nifty 50, Nifty Next 50, Sensex 30, etc. Right? So I firmly believe that index investing is not boring. there are so many index funds to select from. Or more and more type of index funds will come. Just in index itself, there are different categories. There is broad base, there is sectoral, there is thematic, there is strategy. So there is more and more different type of index investing will continue to come. So yeah, this is one of the biggest thing which I feel there are more to cover, but we'll circle around.
Surely. Before moving on to the next myth, I have some questions from our viewers, and I would like to cover at least 3 to 4 questions quickly so that our viewers are also feeling that we are talking to them and we are covering their questions. First question we have is how one can diversify with the help of passive funds. Pratik, maybe you can take this one.
That's actually a great question. So one and I can tie into a myth also in this. I can answer both questions. So there is a myth that passive matlab Nifty, Sensex, and I think that is obviously that used to be the case maybe 5-6 years ago. But passive means index. So investors today are not only obviously able to access products like Nifty and Sensex, but also passive is basically building block for asset allocation. That means there are now hundreds of passive funds across different categories, across different asset classes. So you have passives in commodities with silver and gold. You have international with Nasdaq, S&P. A lot of other funds. You have passive in fixed income also, and you have passive in equities also. And now, hopefully, maybe this year there'll be regulations come in place where you can passive in hybrid funds also. So I think when it comes to diversification, I think what's very important is that diversification can happen in a category level. You can buy a multi-cap fund, Nifty 500. You can buy a small cap fund. You can buy a mid-cap fund. So you can diversify investments by investing in passive funds, investing across equity asset classes. But then you can also diversify using different asset classes like gold, silver, commodities can be one bucket. International can be one bucket, fixed income can be one. So ideally, when at least at MOMC we started looking at passive funds back into 2018-19, there was only equity funds and that too maybe only large cap available. But today, I think the beauty about this market is that we've evolved a lot, and now there's passive funds across different asset classes and categories and multiple AMCs. So you can actually build a completely 100% passive portfolio today. By just investing in these different asset classes using passive funds. And also I think compared to say 5 years ago when I think we have had very good regulations come in place. So back in the day, passive funds had huge tracking errors, tracking differences. That means they weren't very efficient. You had very high costs associated with passive funds 5-6 years ago. But now I think even efficiency for these passive funds that are tracking the index have become a lot more efficient. So I do feel overall, I think diversification can happen in a very big way in passive. And the good thing about this process is that you don't have to really spend a lot of time in fund selection. There is a very, I think, important, in personal finance sort of mantra that, what really matters in your investing style over a decade. So where does your returns come from? Over the long term, most people feel that it's this fund versus that fund will give me much better returns over the long term. But actually, what studies show is that how you distribute your assets across different asset classes is responsible for 90% of your long term returns. So as an investor, if you're looking at say investing into the stock market or the mutual fund industry, a lot of people end up spending a lot of time trying to figure out which fund to buy, which fund to sell. But actually, the real juice is trying to figure out how much of my money should I invest in equity versus fixed income versus international versus gold. So I think with passive funds now it's possible, and you can do it in a very low cost, easy way.
Interesting. Next question is for Pratik and Varun. Question is from Abhinav, and he's asking, how can an investor strike a balance between optimal diversification and avoiding a complex portfolio? Because any which way, जब आप एक index fund लेते हो, and आप almost पूरा market buy कर रहे हो, and if you are having 3 to 4 index fund, you are literally buying everything. So how to strike that balance? Maybe any one of you can start, and other one can continue the conversation.
Sure. Yeah, sure. See, it's quite straightforward. See, the asset allocation depends on your risk appetite, your age, etc. So let's just take example of the 3 simple indexes, right? There is Nifty 50, Nifty Mid Cap 150, and Nifty Small Cap 250, right? So if you want to, depending on and all 3 of these indices have different risk, have different volatility associated with it, have different risk adjusted returns. So small cap is supposed to be more volatile but higher returns. So I would suggest that if you want to say, I want to have, let's say out of the 100%, you want to have exposure of 70% in equity, and you want to create a very simple portfolio. A very simple strategy could be to how much percentage you want to keep in small cap index or mid cap or large cap, right? If you want to keep it very, very simple. If you are a little more advanced investor, you can change this a little bit. Across the, depending on the how much you know about the market, your kinds of fund selection, your allocation can keep changing. So, for example, if you understand passive investing a bit more, you can go inside each market cap and look across the variety of indexes which are available, which is the best index, right? So, for example, in mid cap 150, you can look at out of is the 150 overall broad-based indices or the different strategic indices, which is the momentum or quality 50 or low wall, which one is better for you? And depending on that, do asset allocation across that, right? You can also go into the thematic indices or the sector indices and look at if you want to have a strategic exposure to it, like depending on the market cycle at that point in time. Because India is a very sectoral market right now. So if you are more advanced, you can do more, more selection like that. And simple, if you don't understand anything and you just want an overall broad-based exposure, Nifty Total Market Index is the best way to go because it covers the overall market, right? So depending on how much you understand, depending on where you are in your journey, depending on how much risk appetite, I think the portfolio selection can vary across the different kind of indexes which are available. But very importantly, I will try to capture one of the myth here. A lot of investors which I have talked to believe that passive investing is always DIY, right? It's just that I can do the selection on my own. But more we have gone into the passive investment side, I have started believing that it's almost, or if not equivalent, as complicated as the passive active investing, right? And you should consult your financial advisor. They would be most likely better than you in your financial planning and hand holding you through your journey. And even in index fund, if you want to just invest in index fund, I would still prefer that you talk to a financial advisor. Like there are examples in US, right? There are advisors who just do passive fund advisory, right? And they have created their whole advisory on just that. I'm sure that in passive funds, there would be advisors who can do better fund selection, better portfolio allocation for you if you just continue to do on your own.
Interesting. Pratik, you would like to add something on this?
No, it's a very good question. I think it's a very fundamental question. How many mutual funds should we have? And I think what I've seen is unfortunately. So when I first started in 2019, when I looked at investor portfolios, and I used to also run this service where we used to do sort of advisory to investors, and I've met a lot of investors, like not met but seen a lot of investors who have over 10 to 15 mutual funds in their portfolio. And honestly, which is alarming because if you think about it, and I tell this to most people, is that if you are basically buying 10 to 15 mutual funds, your portfolio is going to mirror a Nifty 500 or a total market index. So it's not going to make a difference. In fact, the more you have, the more stress will give you, because some funds will do badly, some funds will do well, all of that. But if you combine everything, it's going to be a broad-based index. So I believe that I think the best way to tackle this, and this again comes from my experience in the US. Even I've seen ultra HNIs, 25 million plus in assets, 100 crore plus in US terms, which again is a very high number. They don't have more than 6 to 8 mutual funds across different asset classes. So I believe that a simple portfolio is what most people should go for. I think even if you look at a Nobel Prize winning research, if you look at just math, what Bhuvanesh likes, 40 stocks is optimum diversification. Anything beyond 40, they're not really getting much out of it, unless you're obviously focused on one sector or a subsector. I think so. Too much diversification may not really be as value accretive. It might add more stress, but nothing else. So I would say that keeping it simple with a few mutual funds, having it distributed across asset classes, is an excellent strategy for anyone. And don't overcomplicate things. Keep it simple. In today's scenario, with so many NFOs happening and so many people coming and selling you a new fund every month or so, obviously there is this thing that but I think what I've realized in life is in finance, you want to sort of say no to most things. Or if you want to say yes, maybe 80% of your portfolio should be in a very stable long-term portfolio, and you can sort of mess around with your 10 or 15% portfolio. So I think that's what I would say. Don't overcomplicate, keep it simple, and even the most sophisticated investors globally keep it very simple.
So our next question, I think our maximum viewers are having this query, and we have got a lot of questions which are more or less the same. And I'm not sure will we be able to answer it or not, but still I would put forward that question. One strategy, specific funds, I am very sure due to compliance we won't be able to answer or cover it. But if one strategy a beginner want to cover or to start with in passive, what should be that strategy and how to go about it? It's for everyone in the panel, and at least 15 to 20 questions we have it on Zoom, and almost 10 to 15 questions we have on YouTube also around the same question.
Okay,
Maybe
I will go.
Bhuvnesh, you can start.
This is another one of those things which most people shouldn't worry about. There's no holy grail strategy which will get you Jim Simmons wala performance. So I think if you make peace with that in life, you'll be very, very happy. So again, the other thing which kind of bothers me a lot is also most people assume that your goal in life is to beat Nifty 50, Nifty 500 or whatever. If you take a philosophical view, a real benchmark to beat in life is your goals. So anything over and above that is gravy. So you shouldn't really worry too much about it. The second thing is, I think if you just go back to the basics and think about what each asset class is doing. Your equity is for growth, your fixed income is for stability, and gold, I don't know what it does, but let's assume that it does something. So you know these three asset classes have a role to play. And you also know that within, let's say, equities, you have large, mid, small, which are relatively riskier. And the same applies to, in a different way, to fixed income also. And in a way, gold is also as risky as equity. So now if you know all these things and you have some parameters in your head, if you're 30, 40, whatever your age group, most people hate financial rule of thumbs. I'm a mega fan of them. I think even if you assume simplistic rules like, if you're young, you can afford to take more risk. Of course, there are always ifs and buts and nuances in life, but we can't cover that here. But broadly, if that's the case, you're better off just buying a little bit of everything. So you can start with large caps, mid caps, that's more than enough. Small caps requires a little bit of thinking, but setting that aside, even if you were to mix everything together, I don't think that's a bad strategy. Even if you were to start with a portfolio that equally distributes money between all your assets, that's still not a bad strategy. Is there a better strategy? Of course there is, but you'll know that in hindsight. So your goal is to just make sure that you're in the market first, and you're not putting your money in savings banks account or trying to find out some exotic strategy. If you try to get too cute, you will undergo decision paralysis, and you don't want that to happen. So I don't think investors should worry too much of what's a perfect strategy. Of course, there is nothing. For example, for majority of my investing this thing, I think my equity exposure was 100%, and I used to sleep peacefully at night also. It works for me, but it doesn't work for other people. So I think you shouldn't benchmark yourself to what other people are doing or what's a perfect strategy. You just need to contextualize it in your own circumstances and just keep it really, really simple, like Pratik said, right? Like you just need exposure to all the major asset classes, equity, debt, and gold, and maybe you can afford to diversify domestically or globally based on whatever you understand. Even if you do it only in India, it's still okay. You'll end up on the right side. So I would have that's my view.
Makes sense. You have to see what fits you. I remember recently I had a conversation with Ramdev sir, and he was like, मेरे को तो सिर्फ equity समझ आता है, but तुम्हें भी मेरे जितना conviction है तो तुम भी equity कर लो. अगर तुम्हें नहीं है तो फिर तुम अपना asset allocation follow करो. So probably almost the same thing which you put across. Pratik, Varun, maybe you want to suggest or maybe put some light on this point, which can be the perfect strategy in passive investing for a new investor to start off.
Yeah. Varun, go ahead.
Sure. See, I am a big believer of equity. And if a new entrant is coming to the market, and if your horizon is long term, I believe is 5 year plus now, I would suggest that you start off with equity of and be ready for and if you can have some kind of you can absorb some volatility, can accept some volatility, definitely start off with equity. For a completely new entrant, I believe buying the overall market is the best way to go forward. In from an index perspective, just buy total market. I believe in that fund completely, in that index completely when it comes to for a completely new entrant for the mutual fund category, and just forget about it, right? Just look at it over a period of time. See what I have, Anand, what I have seen in investor behavior is that whenever someone starts investing, right, they learn about the market on their own over a period of time, right? Doing anything more than equity in the first fund which you select, I think will be very complicated. That is a market is a very complicated market. While there are simple funds, but they are just classified by returns, right? That liquid gives so much, etc., etc. But I would suggest to start off with an equity, start off with a simple index like TMI, total market, or can do a little broad-based also, a different one as well. But that would be my thought process if I have to answer it very simply.
Pratik, any final closing remark for the complete discussion which we had, along with answering the same question?
Yeah, I know it's a very, I spoke about, the importance of asset allocation over fund selection. But, honestly, what I've realized also, it really depends on who you ask. So just to, just this panel itself, if you ask me, I'll say equity fund Nifty 500. You ask, maybe someone else says say total market fund. You ask someone will be large mid cap 250. So the reality is that I think it really doesn't matter. That's the reality. I think a lot of investors, and I get that question more than anything else, that should I invest in this index versus that index. I do think that if you're sticking to obviously large caps, mid cap types, like very simple ones, broad based ones, they're all going to be very similar in terms of returns. So I think trying to go very nerdy and trying to find the best one may not be the right approach. And I think focusing on asset allocation will obviously determine what sort of returns you can expect in the future, as opposed to sort of geeking out on this fund versus that fund. Yes, there are categories which are slightly more advanced, and those are reserved for investors who are able to take more volatility, or so there is this category called factor funds, or I think smart beta funds. They're not really smart beta anymore, but factor funds. I think where investors have the expectations of outperforming the benchmark over long terms, but even like any other active strategy, it will underperform at certain points in time. So I think investors who are looking to get something different, or trying to establish or play a certain strategy, can also look at those type of funds. But yes, I think when you're looking at very simple broad-based funds, I do believe that keeping it simple and any sort of good broad-based fund with an AMC that you trust is good enough for your equity needs.
Perfect. I think that's a perfect close to a very insightful session. Thank you to all our viewers family for viewing this session. Do stay because we have a further lineup for you. Thank you, Bhuvnesh, Varun, and Pratik for sharing your insights and for such an insightful session. Thank you, everyone.
Okay, thank you so much for that.
Over to the host.
Great. Great. Thanks so much. Thanks everyone for joining in, and thanks Bhuvnesh and Varun for insightful conversation. Thanks Anand for doing such a good job on moderating it. We are now with our last speaker of the day, with Eric for Bloomberg Intelligence, where he writes research for the Bloomberg Terminal. He's also a Bloomberg Opinion contributor and author of the Institutional ETF Toolbox, which was published by Wiley in March 2016. He's also helped create and appear on the first ever ETF TV show called Bloomberg ETF IQ, as well as on a podcast called Trillions. I've been following Eric on Twitter for now maybe 5 or 7 years time, and to be honest, a lot of the innovative innovative ideas have come from some of his tweets, and he's an avid follower of global indices. I can't think of anyone apart from him who can really talk about indices or investing in passive funds from a global lens. So thank you, Eric, for being here. So what we'll do today is we'll probably have Eric maybe present for about 15 to 20 minutes, and then I can jump in for a short Q&A. For anyone who wants to ask Eric a question, please do post it on a comment section on YouTube or out here and on Zoom, and we'll obviously get back to you. But to start off with, Eric, thanks for coming here. I know it's very early morning in New York. I think it's around 7:30. Thanks for coming in, and looking forward to this conversation.
Thank you. Assuming you can hear me, just give me a thumbs up that you can hear me. Yep. Okay. And I'm going to share my PowerPoint. And if for some reason it doesn't start sharing, Pratik, just let me know verbally. But it's great to be here. It is a little early. It's not that bad. I got up at like 4 a.m. once for a South Africa presentation, so this isn't bad. So let me share my screen here and just actually, Pratik, can I share my screen instead or no?
Actually, Eric, the PowerPoint's already been loaded into the system. So is it okay?
I sent you a new one, but that's okay.
Right. Can we share the new one?
I can make him the host right now.
We're just making you the host. You'll give us a couple of seconds, Eric.
Okay, let me just introduce myself while you guys are doing that. Yeah, because I had an extra half an hour, I wanted to add one or two. It's just a couple tweaks, but no big deal. So just to give you some background on myself, I have been covering ETFs and passive funds for about almost 20 years now. My first job out of college was covering mutual funds for a newsletter called Fund Action. I didn't set out to cover mutual funds, but I like business and journalism, so that was my first job. And then I did a couple things in public relations and then ended up in Bloomberg Data. And when I got into Bloomberg Data, they put me in mutual funds. And then I got ETFs in 2006-ish. And when I got ETFs, I was like, wow, this is going to be the next big thing. To me, they were 4 or 5 evolutionary steps beyond the mutual fund. And ETFs are interesting. They obviously track passive, but they do a lot of other things. It's I'll say from Vanguard to the VIX, ETFs track everything. So never a dull moment, but the bulk of the ETF industry, I think, is about the index fund. And Pratik, let me know when that's up and just put it on the screen and then I'll just start talking to it. But so as of now, our team is 10 people. We track ETFs across the world. We write about everything from today, last week, I just did a piece on the new coal ETF and why the price to earnings of 5, might be an opportunity. We also write about say Vanguard's last year in flows. We cover the rise in active. We do a lot of different, like I said, we cover everything under the sun. And, as you can see behind me, there's a Bogle effect. I do that because I'm always marketing the book. A lot of people don't know who he is. But if this is a passive event, you guys obviously know who Jack Bogle is. But I just spent 2 years researching this book. I had interviewed him for a couple hours, 3 different occasions. And the more you think about what this guy, impact he had, the bigger, the more interesting it is. So that to me is the big part of the passive story is Vanguard's structure and their idea of always lowering the fee. It's a unique structure, and arguably the index funds are only so popular because they're cheap. And so in the book, I kind of give Vanguard a lot of credit for doing that to the index fund, and then obviously sparking the ETF from there. So I think it's kind of related to the passive thing. But passive, by the way, is not, that word is somewhat subjective. I think the total market index fund is truly passive, but then you get out of there, the S&P 500, not totally passive. I mean, it's large caps only, and you need certain criteria to get in the index. And then there's an active board that can say no to yes to index it to stocks getting in. So I really genuinely think that yes, indexing and passive is part of it. But if you really, boil it down, it's about keeping costs low which ultimately was, I think, Bogle's life work, was getting those costs low for everybody. And Pratik, are we good?
Yeah, I'm just waiting for my team. I think I just sent them the presentation. But just to maybe I wanted to maybe ask a few questions. Maybe one question.
Let's do Q&A now, and then we'll go to the slides.
Yeah. So my first question is, in India, people are always looking for the next Vanguard. Vanguard is the world's largest AMC, and also, they're passive first, starting by obviously Jack Bogle. Their business model is very interesting, and a lot of asset managers in India, want to be the next Vanguard. But can you maybe you can explain, or maybe you can tell us, why that might be possible or that might not be possible, why there isn't any asset manager like Vanguard in the world, and what would take for us out here to build one in India?
Yeah, the reason Vanguard is so unusual and hasn't been copied is because there's really no economic incentive to set up a company like Vanguard. You have to turn over all future profits to the customers. And anybody who's got the hustle and the brains and the work ethic to start a business probably doesn't want to give all the money away. So that's what makes Bogle so weird and the story is so unique. That said, because Vanguard exists, it almost makes everyone else have to get on their level. So to me, you might not even need another Vanguard, because as long as they're around in the mix, if they're in your country, you're probably going to have to deal with them and keep costs low. Otherwise, they'll steal market share. B, some people are inspired by them. I was in Australia. Beta Shares is definitely a Vanguard-inspired company. And so if you think about that, their influence is all over. I call it the Vanguard effect or the Bogle effect. So, people in the Bitcoin ETF race, there was a fee war before the race even started, and all the fees are now 25 basis points. Vanguard wasn't even in it. So I think that the spirit of Vanguard is already out there. It doesn't really matter anymore. It's like the genie's out of the bottle, and they are so powerful now that they're just going to make everyone else kind of get on their level. That said, there could be somebody who comes along and sets up a company that does what Vanguard does, but I don't even think it's necessary at this point. I think just having them out there and people and the Bogleheads who are all over the world and they sort of spread the message, that's probably enough. But I guess the PowerPoint's up. I can start now if you want.
Yeah. So you can just stay next slide and someone will do it.
Sure. So I'll go fast because I already killed a little time. Next. Okay, so this is my team. If you are in India, wherever you are, we cover the whole world. Rebecca covers Asia, and Henry on the right side of her covers Europe. Everyone else is in US or an associate or CFI. So like I said, we cover the whole world. Next. And we'll do anything ETFs, passive, and even mutual funds. And this is if you have a terminal, you can go BI ETF for the global, and then E is Europe and A is Asia. So there's just sort of deep, I guess, derivatives of the main page BI ETF. And look, Bloomberg has 40,000 functions. I control one, and this is it. But we do put a lot in here. There's a lot of cool tools on the left-hand side. If you're a funds nerd, I highly suggest messing around with this. Next. Okay, ETF assets. Look, I mean, this is a great vehicle. I consider ETFs to be like the MP3. What they did to music, what that technology did to music is what ETFs are doing to investing. It's just a better way to package anything. And you can see the assets are now 7 trillion in the US. They're about 10 trillion globally. And the little dip there is just because the market went down. Next, if you look at the flows, every year, there's a ton of flows. Flows are truth. Assets can go up or down based on the market, but flows are there new customers coming in? And you can see from there, every year flows. 2022, probably the most, 2022, right, is probably the most impressive year. 600 billion, despite the market. Bonds and stocks had almost their worst year ever, and they still took in 600 billion. Major. I mean, that is a heavy lift, and that tells me that it's easy to take money in the good times. Harder when the sky's falling. Next. And then this is a look at ETF volume. Yes, assets are good, but volume is really what ETFs were invented for. The idea that you can get in and out, it trades during the day and the spreads are low, volume is very good for that. Volume tends to go up when the sky is falling. So people tend to lean on ETFs, institutions. And so high volume to me is important, and high volume tends to predict assets and flows. So they're kind of connected. But a long-term investor, volume less important, obviously. But for everyone else, I think it helps. And obviously you want tight spreads. Next. And then you look at the volume across the world, the US really dominates here. We have 86% of the dollar volume across the world, even though we only have, I think, 70% of the assets and like 40% of the products. So some people will even come here from other countries to buy an ETF that holds stocks in their country. That's how big and buoyant this US market is. So yeah, you could be in India, but you actually come over here to buy like INDA, which is the BlackRock India ETF, simply because it trades over $100 million a day. An institution can get out without getting noticed, low impact costs. So I like to say the US exports liquidity. Next. Okay, there's a lot of launches. When you have obviously volume and assets, you're going to get people who are interested to launch products. So here you have a ton of launches, but there's also a lot of closures. So a lot of people throw stuff at the wall, it doesn't work. So there's just been a ton of activity in the ETF market. Again, the early days, those early white lines were all like index funds, like classic Bogle type trackers. The last couple white lines are much more exotic stuff, which I'll get to in a minute, but the industry is definitely evolving. Next. I think this chart shows the number of launches. Yeah, so here's a look at assets by launch year versus products. So the lighter lines are showing you that most of the assets are in the older products. The lines on the right are products by year. So a couple takeaways. The bulk of the assets are in the first generation products still, but the bulk of the launches have come out recently. So 1/3 of the industry is less than 3 years old. So it's still a very young industry. And a lot of those products launched are from big players. So we think this is just, laying the groundwork for a whole, next leg or two of growth. Next. And there's 300 different brands now. So you can see here, this is a great chart. I actually stole this from Morningstar. It's so good. This is the percent of funds, and the number of different ETF issuers is now up to 300, right? That has gone up. It's basically doubled in 3 years because the ETF rule over here. So more and more brands. Again, this is just all predicting a lot of growth. Next. Yes, there's 300 brands, but really 2 of them dominate, BlackRock and Vanguard. They're like King Kong and Godzilla. Everyone else fighting for their crumbs. At least here. I know in different parts of the country, BlackRock dominates some places, Vanguard's pretty big in Australia, but largely, I'd say internationally, BlackRock's stronger. Vanguard, but in the US, in ETFs, Vanguard's about to pass BlackRock. But in overall fund assets, Vanguard dominates everybody. I mean, they have 28% market share in funds, which is almost double the next person. I mean, it's ridiculous. Next. Now, even though the big 2 dominate, and let's look at mutual funds. So mutual funds are seeing a ton of outflows, 1.5 trillion in the past 2 years. That is a ton of money. I mean, they have 20 trillion, but if the market goes up, they still get assets. So, a bear market's almost worse for them. But if an extended bear market or flat market happens, you're going to see a ton of consolidation in this industry because they're going to be forced to do something. But right now, they can actually stomach all these customers leaving because the market just keeps going up and up. So their assets are kind of like stable, even though they're losing people. That's sort of, it's a lucky business to be in where you can lose customers and still make more revenue. But a bear market will obviously force that issue. Bogle once famously said that the index fund revolution has claimed no victims yet. And that's sort of what he was talking about. Next. And if we look at the market share of ETF to mutual fund in the US, ETFs have 31% of the assets that mutual funds have. That's that white line. The top line, the 34%, is the equities. And then the 25 is the bonds. So bond mutual funds have done a better job holding off the passive and the ETFs, simply because bond managers, I think, are a little more revered on the active side than stock pickers. But you can see that all those lines are still moving the same direction. Next. And here's a chart showing the same. Oh, sorry. This is an important chart. So, like I said earlier, Vanguard and Vogels effect is just so amazing. If you think about SPY, which was the first ETF ever launched, it launched at a fee of 20 basis points. And if you look at Vanguard's S&P 500 ETF, that is where that fee got whittled down to by 1993. The reason SPY launched at 20 is because they wanted to compete with Vanguard. So Vanguard just being in the business and having a fee of 20 bips at that point in 1993, SPY launched at that price point. And I think that was like being born on third base. You're immediately ahead of the curve. If SPY launched at 80 bips, there's just no way this would be a retail phenomenon. Like I said, Vanguard's mutual ownership structure kept whittling down fees. And there's so many byproducts of that. It is hard to see sometimes, but the whole ETF industry was based on that low fee, and that's why it's so popular. You have a fee of 80 bips. I don't think indexing or ETFs are nearly as popular. So again, that's why I wrote the book. Next. If you look at the percent passive, so this is because mutual funds can be passive too. So this is percent passive. In the US, 46% of all assets are passive. It's actually a little higher now. This is from 2022 December. Equity side higher, it's already a majority, and then bonds are lower, as I said earlier. So that's where we are in terms of active versus passive. Next. And if you look at the world, I actually looked at the different countries across the world, you can see that some countries, the further to the right is percent passive. So, Japan, the BOJ bought a bunch of ETFs. That's why they're really far. US probably leading the way. And then you look at Australia, UK, Canada, China. I don't think I have India on there. I'm not, you guys are, my guess, if I had to look, would be maybe 20%. I don't know. You're probably in that ballpark, but most people are in this sort of like 10 to 20 right now. US being 46, and the size of the bubble is the size of the market. So I think the US, is going to lead this. There's two things you need for passive and ETFs to grow. And, you don't need all of them, but if you have these two things, the market should explode. One is you need a population who doesn't assume the government will take care of your retirement, because that's going to make you get into how to pick a fund. And as soon as you get into how to pick a fund, you're going to realize how you get a good deal with indexing. Number two, advisors who get paid as a percentage of assets versus a kickback from the mutual fund. So in the US, we have 85% or something of advisors who are now fee-based versus commission-based. So we have both those things in spades. That's why we lead. As the world turns and people get more into a defined contribution situation in their country, and advisors move from commission to fee, you will see passive and ETFs explode. It's that simple. Next. And here's a look at the assets by vehicle in the US. Mutual funds still about half, ETFs about a quarter, almost 40%. Money market funds still have a ton of money here. And CITs and direct indexing, I won't go too into them, but there are definitely some other things that do have some value. But largely the ETFs are going to eat most of that mutual fund blue. Next. And if we look at the US, you can see here that you just skip this slide. This is just mutual fund assets are going to be spread around mostly the ETFs. And where do we end up in 5 years? So I think ETF assets will double. I agree with JP Morgan. That was their call. If you look at the number here, it's doubled every 5 years. So we just think another doubling in 5 years puts it at 15 trillion, probably a good chance of this. Next slide. And if we think of the global scene, right now we have 10 trillion in passive. This is BBH. They think 30 trillion will be in ETFs. That would be a threefold increase. Again, that would take a lot of help with the market, but I think it's achievable. Bigger takeaway though, BBH and JP Morgan pointing out this stuff is amazing. Back in the day, it was just ETFs were underground. The mainstream didn't want them to be successful. Now they all kind of accepted it, and now they're even promoting it. Big change. Next. And then let's talk at some big topics from this year, and then I'll end. The Bitcoin ETF Derby. You can see there was 9 new ETFs launched, and then GBTC converted, but they've been a big hit. They're already up in the billions in terms of trading and volume. And that's a good sign. Bitcoin ETFs are, here to stay. I mean, this is a whole new asset class. You have Larry Fink out there talking about them, Fidelity. This has given advisors a lot of cover to get interested. Before it was like, I don't want to use some crazy exchange, but hey, it's BlackRock. So this is a big deal. This is going to develop a whole new asset class here. Next. And if you think about the ETF, and I always knew this would be true, you can put anything in an ETF and you give investors a good deal because of the creation redemption mechanism, which allows for arbitrage. So this is a look at the arbitrage band, or the percent premium discount. You see how it started high for Bitcoin ETFs because it was a new market, but see how it's been whittled down to almost nothing. That's because the competition amongst market makers to do arbitrage is so intense that now you can only make about 10 to 15 basis points doing an ARB on a Bitcoin ETF, which is amazing. In other countries, it's higher. It's like 50. So the US is just so loaded with competition and the ecosystem. That's, again, why people come over here for our liquidity. But you love to see a chart like this. This is investors getting a better deal. The lower that is, the better. Next. And then active ETFs are finally breaking through in the US. They're popular elsewhere in the country, but largely because of that commission thing I talked about. Generally speaking, look, I know you guys are into index funds, and so am I. I own them. But the thing and the Bogle effect, active finally got cheap. That's why it's popular. People are open to some active, but they don't want to pay 100 basis points to own like Google, Apple, Amazon, and all the other normal stocks in the S&P. So that's what changed. They all got lower cost. And so 80% of all new launches last year were active, and 25% of the flows were taken in by active ETFs. Next. And a big reason for that is this. If you take the active share of the ETFs and then the fee, and you graph them, and you draw a 45-degree angle, I call that the beta adjusted fee demarcation line. If you take the top 10 best-selling active ETFs, DFA, JP Morgan, ARK, and you put them on this grid, you see they're all above the line. What does that mean? That means that the lower difference you have from the benchmark, the less you need to charge. The higher deviation from the benchmark, the more you can get away with charging. In other words, people only want to get charged for the amount of active because beta is free now. So it's like a bag of potato chips. You don't want to get charged for the air, just the chips. And that is what the future is for active. You need to beta adjust your fees and you'll find success. Next. And this is part of the changing of portfolios, because it used to be you chase a 5-star manager to another 5-star manager, and that was like your whole investment in the 80s and 90s. Vanguard came along, made beta free, and everybody was like, oh, screw that. I'm just going to buy beta for the core. So the 60-40 is now free, basically. So that's the cheap beta, but it's boring. And people don't have patience to just sit there year after year. They want to have a little fun in the market. So I think there's 15%, maybe a little less, for hot sauce. This is just crazy stuff that's very different from beta, that just cures your FOMO, may have you a little fun. So this is where Bitcoin will have success. This is where ARK has been able to hold up their drawdowns. This is where thematic ETFs are. So to me, this is the modern portfolio, which is why if you're active, passive, or whatever, you better be cheap or shiny. The middle is screwed. Next. And this is why single stock ETFs, which are literally an oxymoron, these should not be a hit, are a hit. Put a little leverage, like Tesla times 1.5, Tesla short. Look, it's got $1 billion because there is a demand to have a little fun while you wait for the paint to dry on your 60-40. Next. And derivatives. Derivatives are really a big part of this year. People are now sculpting outcomes. You can use derivatives to predict your outcome. Oh, I can promise you we'll take care of 10% of your drawdown. You take care of the next 10%. And so this structured products essentially being put into ETFs, I think it's great. I mean, it sounds a little dangerous, but not really. It's just options. And it's just stuff you could do on your own, but it's a pain in the butt. So they package these options in a way that sort of helps you have an outcome you desire. It's better than doing variable annuities, which really are fee-laden or garbage products. The ETFs, I think, at least are lower fee versions of those. Next. And I think those are popular. And then the Qs, even though you guys are all into passive, like the Qs isn't really passive. It's sort of a hybrid of active and passive, but it's really a marvel. It's really packages, in my opinion, the American innovative tech thing. and it's doubled the S&P. And so we on our team, we just wonder, when will this end? When will this sort of Q dominance end? And that's a big theme we've been watching. It's just, I don't know. The answer, people have been saying for 10 years that it should go to small cap value, but it hasn't. Next. And then when we think about the ETF issuers, the ones that aren't the big three have done a good job of getting stronger because they got cheap. JP Morgan, Avantis, Capital Group. So the non-big three issuers took in 44% of the assets last year. That's a good sign. Again, because we don't want two companies dominating everything, right? So again, this is part of the Bogle effect or the Vanguard effect. Once they got with the program and met ETF investors on their terms instead of on the issuer's terms, they found success. Next. And obviously the big two is still utterly done. I think I had this chart earlier, so just skip it. Next. Smart beta. Even though we don't talk about smart beta anymore, which to me is a hybrid of active and passive, it's an index that you tweak a little bit. Dividends, value, growth. All these smart beta ETFs are now below like 7 basis points. I mean, it's ridiculous what you can get now in the smart beta, and the assets are coming. It's just not fun because it's not new anymore, but smart beta crushes. And I, for one, think this is an evolution of active. It's active, but with all the benefits of the index fund. And I think it's a beautiful thing. Plus, there's no emotion. The discipline rebalancing can actually help you pick up some good deals that a human would be unable to do. Next. ESG. I was bearish on ESG from the first day it came out. I'm still bearish because ESG was always, at the end of the day, it was active management, but it was never sold as that. It was sold as, we're going to change the world, you're going to sleep at night, and we're going to outperform. And none of those things happened. So ESG is in real big trouble. There hasn't been an ETF with ESG in the name launched in a year. Larry Fink hasn't uttered the phrase ESG in a year and a half. This is a serious problem. They're going to try everything they can to use the word climate instead of ESG, but this space is going to be relegated to like 0.5% market share. And it's going to be like, look back as just this wildly crazy 3-year hype machine that went wrong. Sorry to be harsh, but the marketing was duplicitous from the beginning, and everybody found out after it started underperforming because energy had a rally. And yeah, they're in trouble. Next, I think that could be it. Yeah, and here's some places to find me if you're interested. Free podcast, TV shows free, and there's some books. And I'm on Twitter a lot too. So if you don't have a terminal, those are some places to get my stuff. So with that, I'll end and turn it back to Prateek. I think you're muted. Okay.
All right, thanks. Thanks, Eric. That was an excellent presentation. Thanks for the slides. And that was a good overview on the global markets. I just had a couple of questions. Maybe we can have that and then have a vote of thanks. The first question is active ETFs. You know, what's happened is, at least in my perspective, is that ETFs has become a structure, not really passive. So do you foresee, not now, but in 10 years' time, all actively managed mutual funds converting themselves to ETFs, and thereby ETFs becoming a structure as opposed to sort of like a passive realm?
Did I see all the active funds converting to ETFs? Not all of them, because they're cash cows. And so a lot of these funds are going to ride these cash cows till the end. But in the meantime, they're going to try to launch ETF versions of them.
Yes.
Some may convert, and I think that they should. There's also some, you gotta understand, there's some older people who run these fund families. They may just not have the energy to go into the ETF Terradome and compete with Vanguard and BlackRock. They may just sell their company. Eaton Vance did this. They sold to Morgan Stanley. I think there'll just be a lot of people who are like over it. But the ones that do make the tough decision to go into the market, I think conversions and also having an ETF share class connected to your mutual fund, those will be two ways to sort of get in the game. But at the end of the day, there's no way around the fact that you're going to have to do some self-cannibalization if you want to survive. And just the way it is, and it's the harsh truth. And some have, there's like JP Morgan's a great example. They've launched cheaper. All of their ETFs are priced at the institutional share class of the mutual fund. And that takes guts because it says to the other retail investors in the mutual fund, you can get a better deal on the ETF. And that risks cannibalization of themselves. So The ones that have had success are the ones that are willing to do that, but for the benefit of future growth. And so anybody willing to go through that crucible will have success. If you're not, you'll probably just be bought by somebody in the next 10 years.
Got it. Got it. The second question is on, I think, sitting out of India, you almost expect Vanguard and BlackRock to get, the incremental flows. But it was interesting to see that, above 40% of the flows are coming from the non sort of top issuers. Is this due to just pricings, or are they also sort of, adding a little bit of innovation to the industry?
Both. Again, let's look at JP Morgan. What's the JEPI is the most popular active fund ever. It beat ARK in terms of taking in money and growth. JEPI is active. There's a fundamental screen. It's run by a talented guy named Hamilton Reiner. Then they add a covered call strategy on top of it. What this does is it gives you extra income. So it yields, I think, like 8-9%. The income can be like a buffer. When the market goes down, the income acts as sort of like a hedge. So you don't feel the full brunt of the downturn. Older investors, we call this stuff boomer candy. Boomers love this idea of hedging a downturn. So they get to participate, but their downturn is hedged. All that for 35 bips. So you're getting cheap active, but with a little extra legwork involved. And that's what you got to do. That is hustle active. And so I think that's true. DFA is a good example. They do quantitative active, but their stuff is all below 20 basis points. They even have one active fund that's below 10. So they are really setting the tone. And these are the ones that see the most flows. So what this tells me is if you can do some legwork or innovate and be cheap, you will probably find success. Advisors are very cost conscious now because their money comes now out of the fee of the pie of the investor assets. So now that their money is coming out of the client's assets pool, they're cost conscious all of a sudden, right? Back in the day, the mutual fund just paid them off not to be cost conscious. So now they're cost conscious. They're looking for this stuff, and they're open to being sold to for sure, but they want it to be fair. And so those two companies are leading the way. This isn't anything new. Smart beta wasn't really a hit until it got cheap. ESG, even though the outflows are coming, was around for 10 years. It didn't start to get some traction until it got cheap. Vanguard itself started the index fund at 50, 60 basis points. It didn't get down to under 15 until like 2005 to 2010. And that's when it took off. So like there's a pattern here, right? As soon as you get below 40 and then 20 basis points, these thresholds, advisors start to look at these products and give them real consideration. So the ones that are expensive, the only way they'll even think about it is if it does something really radically different and can be used in small doses as hot sauce. So again, that goes back to my beta adjusted fee demarcation line. So I agree with you. All these companies that are finding success, we're studying them. And so we're explaining to our clients, what do they all have in common? And the answer is they adjusted their fees to account for the fact that beta can now be purchased for free.
Got it. Great. Just the last question before we wrap up. We obviously saw the Bitcoin ETFs getting listed this year, or maybe end of last year. And what is the sort of innovation that you are expecting as you are talking to asset managers in 2024 or 2025?
I mean, the digital assets is a huge space. I think we'll see an Ether ETF. I think that's it though. But remember, the ETF industry is very creative. So we're going to see a Bitcoin ETF that goes long Bitcoin, short gold. We'll see like a leveraged Bitcoin ETF. We're going to see covered call Bitcoin. We're going to see, smart beta Bitcoin. Who knows? But we're going to see all kinds of spaghetti thrown at the wall. And, a couple will stick, a lot will be liquidated, and that's just the way it goes. So I'm looking more for not new coins that get put into the ETF, but what innovations on top of Bitcoin actually stick. And there's a plenty. So we have a whole new category that's just been born, and it should get pretty exciting for both Bitcoin and probably Ether. And then, I don't know, maybe 10 years down the road, there's a bunch of new stuff tried. But for now, I don't think there'll be any other actual cryptocurrencies put into the ETF wrapper. There'll just be those two. But there could be 50 different funds tracking Bitcoin, in 2 years from now. But they'll do different things. And, like I said, that's okay. This is part of capitalism. You try things, whatever sticks, you will see. And that is a big part of innovation. But as I said earlier, structuring products to target outcomes is a huge growth area. Cheap active is a huge growth area. So there's plenty of and thematic is a huge growth area. So there's plenty of places to move forward and evolve outside of just like cheap index funds. And that's why you see these companies trying, because you can't launch a cheap S&P. To launch anything in the 60/40 now, it makes no sense, because you'd have to get below Vanguard's price, and that's basically free. So what's the point? So all of the innovation and the hustle and the attempts are going to be these other areas. But the good news is all that competition will mean that even the hot sauce stuff will eventually become cheaper and more liquid as well. So, but in the process, there'll be a lot of crazy, wacky stuff that just like, ends up in the dustbin of evolution. Kind of something that has been attempted and is no longer. So the more passive grows, the crazier ETF launches will become. Not just crazy, but I'd say more creative. And I think that's where the industry is headed long term. And that's fine. I think it's okay.
Got it. Great. Thanks a lot, Eric. That was a very interesting session. I think we really enjoyed it, and hopefully we can have you in person sometime in the future. But thanks a lot for coming in this early morning, and we look forward to more association with Bloomberg and your team. Thank you so much.
Yeah, thanks for having me, and everybody, have a good, I guess it's night over there. Have a good night. See you guys. Bye.
Right. With that, we end our third passive funds conclave. Thank you for everyone who's joined us for this really nice event. I think all of us really enjoyed it, and it was very informative. It was good to see a woman-led panel. It was excellent to see Monica Alan, who is obviously an award-winning author, talk about personal finance. We had an industry panel, which was very good. We talked about how best you could structure your portfolio using passive funds. And obviously, we had a very good global perspective with Eric, who was very insightful, and really, maybe we could see how things turn out in India based on, I think, what happened in the US in the last decade or so. So we know what to expect, in Indian market soon. So with that, we thank all our viewers for joining us, and we definitely want to do this more often. So, especially yearly events. So we look forward to having all of you next year in 2025 for our next conclave. Thank you so much, and have a good night.